we can wait maybe one more minute for a few people to join, and then we'll be ready to
and I have no announcements to make. That's all Pierre's, because Pierre's finishing things up. Okay, that's easy.
Sure.
Okay, ready to go when you are.
Okay, let's start then. So you're all very welcome to the second day of this 74th Economic Policy panel meeting. We're going to be starting with a paper on central bank reform and the political economy thereof, to be presented by Davide. So I'm looking forward to hearing that. Just a reminder of the timings. So presenters have 20 minutes to present. There will then be two discussions of 10 minutes each, leaving 15 minutes for a general discussion. So please try to stick to the timing. Okay, Davide, the floor is all yours.
Thank you, Kevin, and thank you everyone for the opportunity, for being here and for the opportunity to present this paper. So this is a project in which I will give you an overview of the political economy of reform of central bank institutional design using a new index of central bank independence. So when we refer to central bank independence, we typically think about the degree of freedom of monetary policy maker from direct political influence, right? And so this concept has largely shaped both the research on monetary policy, but also the institutional design of central bank over the last 4 decades. For example, by now we know why central banks should be independent, how we measure the degree of central bank independence, and what are the consequences of central bank independence. So despite, however, this large consensus on the benefit of having central bank independent, there is a large variation in the timing of reform and the magnitude of reform taking place in central bank institutional design. And let me also add that despite the large discussion on the optimal design of monetary policy, there are no systematic studies on the drivers of reform of central bank institutional design. So just to clarify, when we think about how to measure central bank independence, the literature has mainly focused on two different approaches. The first one, which is closely related to this paper, consists in creating de jure measures of central bank independence, which requires a close codification of the central bank legislation. And for example, among the most cited paper and most well-known paper in this literature, there is the Grilli, Masciandaro, and Tabellini, which was published in Economic Policy exactly 30 years ago. And also the Cukierman Index is the most one of the most well-known index of central bank independence. When we look on the other side of the de facto, and this will not be discussed in this paper, but basically the de facto measures, they try to look at how often the central bank governor is replaced, and this will be considered as a good proxy of the de facto independence of a central bank. So following the creation of these indexes, a large literature has shown that central bank independence can create a benefit for reducing inflation rate in a country. So most of the studies that have been conducted on both advanced and developing countries suggest that improving central bank independence in a country will reduce the degree of the level of inflation in a country. However, most of these studies were focused on correlation. Simply we're not computing dynamically these indexes, but actually recomputing these indexes at various points in time without taking into account the exact timing of reforms. On top of this, we also need to consider that, especially starting from the global financial crisis, central bank balance sheets have expanded exponentially. So we have more and more pressure on central banks to distribute profits to the government. And so with the increase of the balance sheet, there has been potential issues of concern regarding the degree of central bank financial independence, and also the need for a central bank to report more and disclose more information on their balance sheet. But so the first limitation that I found while starting this project was actually the lack of data on the timing, size, and evolution of reform on central bank institutional design. So what I do in this paper, first, I compile a comprehensive database on central bank institutional design for a large set of 155 countries. And then I also create an index of central bank independence, which is mainly created by expanding existing indexes of central bank independence, but also taking into account also the new elements of central bank financial independence and reporting and disclosure. And then in the part of the econometric analysis, what I try to understand is the drivers of, try to identify when, by how much and why certain central banks reforms or certain countries reform their central bank and some others no. And so what I find is that the initial level of central bank independence, regional convergence, as well as an external pressure such as receiving an IMF loan are important drivers of reform, while less so can be said about political factors, economics, or even crisis episodes. So just to give you a brief overview of the index, when I was mentioning before the most common indexes of central bank independence, the one proposed by Greeley, Machandar, Tabellini, and Kuckerman, they focus on mainly 15 and 16 questions on central bank independence. So this index is provides more information on central bank institutional design, for example, to take into account the fact that now central banks' decisions are taken by board and not only decided by the central bank governor. And this allows me to have 6 broad dimensions of central bank independence, which are the basic 4 dimensions of the old indexes of central bank independence, and I have the 2 additional dimensions. For the purpose of this presentation, I will give you an idea when I will talk about this CBI index, which is Central Bank Independence Extended Index. I will focus on an aggregated measure in which I simply have computed an average measure of this independence index across these 6 dimensions. So the index ranges from 0 to 1. And a value of 1 will be associated with a higher level of central bank independence. Just to give you an idea on the size of the sample, well, you have already heard about the sample size and the period of the analysis, but the number of central bank legislation which I have analyzed, and central bank legislation refer either on reprint of the central bank legislation or amendments, so shorter text. I have analyzed a total number of 2,500 legislation, roughly 2,500. And if we ask ourselves how often these reforms or changes to the central bank legislation impact the design of central bank independence of a central bank, we'll find that roughly 290 changes had an impact on the independence of the central bank. So this table here shows you how this index contributes in finding out the number of reforms. In this case is 286 as compared to much smaller number of reforms, which are allowed to be computed by looking at the previous studies proposed in this literature. So as I mentioned already, over this period of time, if we look at the right-hand side vertical axis, we see here that at the end of our period, so 2017, we reached a total number of 286 reforms. When we try to disentangle the number of reforms which increase the degree of central bank independence, so here on the vertical axis on the left-hand side, we will have the number of reforms, the positive number are associated with the number of reforms implemented in countries which increase the degree of central bank independence. We see that most of the reforms which increase the degree of central bank, most of the reform in general increase the degree of central bank independence. Most of the reform also took place post 1985, when Rogov published his famous paper on the importance of central bank independence and delegating monetary policy decision to independent policymakers. And we can also see when we look at contraction in central bank independence that most of the reforms which decreased the degree of central bank independence took place in the late 2000s and post-global financial crisis. So this graph will not be surprisingly. I've already mentioned to you that most of the reform improved the degree of central bank independence. And so if we compare on the vertical axis, the most recent index of central bank independence for any single country, so a dot here represents a country, and on the horizontal axis, we will have the original level of central bank independence of that specific country. We see that most of the countries are clustered across the above the 45-degree line, suggesting that over time, central banks have received a higher degree of independence. However, when we try to understand and look at the evolution of central bank independence and differences across country and across region, we can actually see that there exists a more heterogeneous distribution of the degree of central bank independence today as compared to the 70s, 80s, up until the 90s. And at the same time, you see that we can say that overall, despite this large literature on the benefit of central bank independence, we still see that advanced economies are the one that are characterized by higher degree of central bank independence, while there is also huge heterogeneity across developing countries in terms of distribution of these indexes. And so this motivates our idea of trying to look at the determinants of central bank design. So what are the elements which will influence these changes in central bank independence? And so I use by looking at the large political economy literature, we came to the idea that, well, political institutions, also following this idea of endogenous political institutions, evolve endogenously in response to changing political and economic conditions. And so by looking at this large political economy literature, we already know that, for example, there exists a status quo bias suggesting that countries that have already characterized by a high level of an index of not only central bank independence, but for example, financial development, will be less likely to reform and improve their development even further. Other elements that might influence the probability of reforming or changing the degree of central bank independence is, for example, what I call here an external inducement or external pressure. We know that, for example, there is already now a large literature on peer effect, which suggests that countries, they behave and they try to follow up when they implement reforms, they try to catch up with their regional peers. And so here I will have a measure of regional pressure computed as the difference between the average level of independence in a region where a country is located minus the level of independence of that country. So which will be indicating how distant a country is from the regional peers. And then other elements that could improve or increase the pressure on a country to reform could be actually what I call the classical external pressure that comes from World Bank or IMF loan programs. We also know that there is a conventional wisdom that suggests that it takes a crisis to reform. And so here I also control for a set of elements and variables for crisis and other type of shocks, as well as political and economic condition in a country. So this table where I actually outline all the variables, control variables that are used in the paper, and then in the following tables, you'll only look at some of the most important key elements that I want to outline, and they are also outlined in the paper. In this basic setting, you will have that this table is actually the baseline table in the paper, and from column 1 to 3, I add the additional control variable. In table 4 and 5, I split the sample between to see whether the results are different by looking at advanced economies versus developing countries. And so what we see is that the negative and statistically significant coefficient for status quo suggests that countries that are characterized by a lower degree of central bank independence in the previous year, they are actually those that are more likely to implement large changes in central bank institutional design. When we look at the external inducement or external pressure, we can actually see that both the regional pressure and the IMF loan programs, they boost reforms. So they are positively and statistically related to the change in the degree of central bank independence, not only in the overall sample, but also when we focus on developing countries. we don't have any evidence for advanced economies. And if you remember, when I was mentioning the conventional wisdom on it takes a crisis to reform, I don't find so far any evidence of financial crisis, currency crisis, and sovereign debt crisis influencing the change of central bank independence. However, if you think about another crisis, which is more related to monetary policy, inflation episodes, so periods of high inflation are associated typically with reforms which improve the degree of central bank independence in the overall sample, and in particular among developing countries. However, this index also allows me to, and this database also allows me not only to look at the sign, but also at the direction of reform, right? Someone might think that the size and the magnitude of the change might also be conditional on the way that I have assigned to the different component of the index. And so a way to test whether my results are robust in this case is, for example, to take a more agnostic approach, think that rather than looking at the magnitude of changes, I now look at I create now a dummy variable for capturing reforms. So all the changes in central bank independence, which improve the degree of central bank independence. So in this case, the dummy reform will take a value of 1. Large reforms are those that increase the degree of central bank independence by a value that is higher than the median value of the improvement in central bank independence. And we can also see whether there is a difference in the driver of reforms versus reversal and large reversal, which are referred to episodes in which, rather than having an increase in central bank independence, we have a contraction in central bank independence. And so what we see is that, well, the status quo variable influence the probability of implementing reform. The regional pressure is more and more important when we look at implementing large reforms, suggesting that countries that are the farthest away from their peers will be also likely to implement larger reforms. And somehow in support to this idea, we see that with the negative and statistically significant coefficient for the relationship between regional pressure and large reversal, we see in this case that countries that are already the farther away from their peers, they will be less likely to implement a reform that largely reduce the degree of central bank independence, right? IMF programs, they affect the probability of reforms, but not those of reversal, and so contraction in central bank independence. And finally, when we look at financial crisis, we can see here that the financial crisis influence the probability of reversal and not improvement in a central bank independence. So the index also allows me to look at the various subcomponents. There are the 6 dimensions, and so to see whether the results are consistent, I also look at the drivers of the different component of the index, so the different dimensions. And so we see that the status quo variable is strongly statistically significant and negatively related to the probability of any type of reform in the different dimensions. Regional pressure and IMF loans program matter more for changes in monetary policy, so improving the independence of the central bank in adopting monetary policy, and also in setting the condition on lending to the government. While if we look at financial crisis, it seems that probably in support with what we have seen, especially during and after the global financial crisis, with the increasing pressure on the central bank to distribute more profits to the government, we see that financial crises are typically associated to episodes in which there is a contraction in the level of financial independence. So in the paper, we also discussed that there is a large political economy literature that also try to understand whether democracy are important drivers of reforms. So in the baseline setting, we use the polity index that is normally used in this literature. But then in this set of robustness, we replace the polity index with a dummy variable, which indicates whether a country is a democracy or not, following Giavazzi and Tabellini. We find that the democracy dummy per se does not drive reform, but then we also compute a democratic reform dummy, which takes the value 1, when a country moved from being an autocracy to a democracy. And here we find that countries experiencing a transition from a more autocratic government to a democracy will implement a reform which improve the degree of central bank independence. And when we probably a more worrisome result is that if we try to look at the rise of populist government, we see in more recent year, we can see that when we look at the nationalist index, we see that when governments become more nationalist, we are more likely to experience decrease in the degree of central bank independence. In the paper, I also ran a set of robustness check for testing the results, but let me move on to just to summarize briefly the result, and then I will leave you to an open question on what it is the result of the paper so far and political implications. So what we know is that in this paper, I have provided a large database on the timing, evolution, and magnitude of reform on central bank institutional design. Likelihood of reform is mainly driven by status quo, regional pressure, as well as external inducement mainly. This paper aims contributing to a large literature on the political institution by underscoring the importance of understanding the actual dynamics of reforms, the reform process. The database is publicly available, so please feel free to use it. And just to conclude with probably an open question on whether can we consider, especially after this increase in central bank independence, whether we can consider central bank independence for granted. My answer here is no. We have seen yesterday during the discussion from Markus Brunemeyer and the various discussants that climate change and the involvement of central bank in climate-related issue could undermine the degree of central bank independence. And we have also seen here, also with some tweets from Donald Trump and other newspaper articles, that the growing number of central banks around the world, especially when there are more populist government, have received more and more pressure that calls their independence into question. Thank you for your attention, and hopefully I managed to finish on time.
Thanks very much, Davide. Okay, so our first discussant is Sophia.
Okay, thank you for asking me to read this paper. It's small disclosure. This is really not in my topic, so I did learn a lot from the paper and I enjoyed it. And I hope I can make some comments that might be useful. So, sorry. What does this paper do? They basically, or Davide basically extends two previously used indices to measure this central bank independence and add two new dimensions, financial independence and reporting and disclosure. And then I think the big work in this paper is that he calculates this index for 155 countries and for all years between 1972 and 2017 when the data was available, and look at general trends in this index by subcategory, by region, etc. And finally, the bulk of the paper is about analyzing what are the correlates of changes in this central bank independence index. And this is done by reduced form regressions inspired by a political economy model of institutional reform. So why is this interesting? Okay, I think this is interesting because central bank independence is considered the ideal institutional setup for stabilizing inflation. And there's a wide consensus on this since the 1970s. And yet, by doing this extensive data work and analyzing the evolution of this index over time, Davide discovers like new and interesting patterns in the central bank independence. So what we see is that there's a large heterogeneity across countries, despite the fact that there is a wide consensus on this being the ideal optimal institutional setup. So the question is then, why has it not been implemented everywhere, and what determines its evolution? And my understanding of the results is that these improvements in the central bank independence come in regional waves, and usually these regional waves are induced by some external factors, and maybe this didn't happen everywhere in the world to the same degree. So I think you described these changes very well over time, that this central bank independence increased in almost all countries between this time period, and it increased in all regions, but to quite a different degree. And you also show in the paper that the largest improvements are along two components of this out of the six, along the objectives and along whether the central bank lends to the government or not, or how the lending to the central government is regulated. What I would have liked to see on top of these patterns is to see the evolution of each subcategory by region, just to understand whether is it that the objectives only improved in one region and the lending to the government in another region, or is it that there is somehow a similar evolution in all regions in along these different categories? Because I think they regulate somehow. They really mean something different, right? If the objectives improved or if the financial independence improved, that means something else. The empirical framework, so you showed this this equation, is to regress the change in the central bank independence on the previous level of the central bank independence indicator, and then all of these factors that are taken from the political economy literature. And plus there is this country fixed effect, and then there is a time fixed effect. So the country fixed effect is, in the paper, it is described as this would capture a convergence to a country specific level of the central bank independence index. But because we are regressing the change on a country fixed effect, I think this implies that there might be a country specific constant change in the central bank independence index, which to me doesn't make a lot of sense, because this index is between 0 and 1, so we can't really expect it to be growing at a constant rate or changing at a constant amount. And also I would consider looking at, instead of just the time fixed effect, which is meant to capture waves of reforms, to maybe look at country region fixed effects, sorry, not country, time regions. Time region fixed effects to capture kind of these regional waves if possible. So you have discussed in detail these different elements of the results, but I wanted to just highlight that what you find is that depending on whether the country is developed or developing country, different correlates, different things correlate with the change in the central bank independence. And I think the biggest difference is between these external inducements, that in developing countries, this is regional pressure, meaning how far you are from the average in the region, and whether an IMF program was implemented. And in developed countries, it's whether the country joins a monetary union or not. So I found it very interesting when you refined the results and you showed whether these results are robust if we look at different across the changes, where you cut the changes by the direction of the change, whether it's an improvement or a reduction, and in the magnitude. But I had a question about the interpretation of the large negative coefficient on the regional pressure variable. So you interpreted this as large reversals are less likely in countries far from the regional average, because there's this negative coefficient. But I thought that this distance is not in absolute terms. So if you're far above the average of your region, that will be a negative distance. And then you multiply that with the negative coefficient, that would increase the probability of a large reversal. So that's a clarification question that I hope you can explain. And then I found it also very interesting, the finding that moving from autocracy to democracy goes together with increasing CBI. So it seems that democratization and central bank independence go together. And on the other hand, the increasing nationalism or populism goes together with a reduction in the central bank independence. I found these very interesting. So here I have a question, because I really had this understanding of the paper when I read it, that there are regional waves of central bank improvements in central bank independence. And I don't know whether this also happens in terms of reductions. But how I understood your results is that central banks become more independent in countries where the initial level of independence is low and which are far below their regional average. And so I was wondering, like, what could initiate, a regional improvement in CBI? What is going to induce a region to kind of collectively move to a higher level of independence? And here, I think the other correlates give some insights into that, namely that maybe if there is a democratization process in some of the countries, or countries become more integrated into the global economy. Also, these IMF programs or high inflationary periods in developing countries, and monetary unions in advanced regions. So I thought that this means that there's a potential for these regional waves of improvements in the central bank independence. On the other hand, I think your results show that central banks become less independent in countries which are far above the regional average. So there is also this convergence to a lower level of CBI, from my understanding. Or if there is a financial crisis, they become also less independent, or if nationalistic or populist parties take power. So that would also imply that there is a potential for regional waves of CBI decreases. And if that's the case, I thought it would be very nice to see in the data if you can see such waves in the data, because maybe you could look at regions and look at, over time, how do these indices evolve in different countries, and see if you can pinpoint, okay, here this region started with these 3 countries getting an IMF loan, and that kind of then ratcheted on to the other countries. And my final question is about the changing mandates that you also mentioned, which is that now you hear a lot about either the banks themselves or the governments putting pressure on central banks to expand their mandate, with putting more emphasis on full employment, on contributing to equality on the labor market, and somehow contributing to mitigation of climate change. And this would, of course, change the meaning of central bank independence, because it would mean that it might not be central bank independence that is the goal anymore, but there will be a different optimal institutional setup for central banks, given that the economic environment has changed. And I was wondering whether your results could suggest that these wider mandates will also spread in regional waves that are induced by some external pressures. So I think I'm out of time, and I'm going to stop here. So thank you very much for giving me the chance to read this. Thanks.
Thanks very much, Sophia. So next up is Fiorella.
Thank you. Let me see. Okay, thanks so much for inviting me to discuss this very nice paper. I really found it interesting. Now, there are 3 main questions that are asked in this paper. The first is, what are the main drivers of the changes in the design of central banks around the world over the past decades? And the second is whether the main drivers of these reforms are common to both changes on the upward and on the downward side of central bank independence. And third, are these drivers common across countries? With this objective in mind, the paper builds a dynamic indicator that covers around 290 legal changes in central bank independence for 155 countries over this extended period from 1972 to 2017. And it does so by extending 2 commonly used indicators of central bank independence, and by providing additional measures to quantify 4 previously proposed criteria, namely the appointment of governor and board, the monetary policy and interaction with other institutions, the conflict resolution, the objectives that are mandated to central banks, and for the possible limits to lending to the government. But Davide goes beyond that, and it proposes 2 new criteria that are interesting because they can also provide additional information that is relevant in periods where central banks have used extensively unconventional measures. And these relate to financial independence, which among others look at the distribution of profits to the Treasury, but also on an additional criteria on reporting and disclosure. And let me stress that, as Davide was saying, the paper focuses exclusively on measuring de jure central bank independence, meaning legal changes to the institutional characteristics of central banks. And this is one slide on the main findings of the paper. First, the paper documents that central bank independence has been consistently increasing over time and across regions over the sample considered. The largest contribution to this increase in independence comes from the fourth criteria, which is which measures the independence in achieving statutory objectives of central banks, while the smallest contribution comes from the newly introduced criteria 5 and 6, which are financial independence and reporting and disclosure. So when it comes to the most important drivers of the observed increase in central bank independence, it seems that the status quo is very relevant, and this is the starting level of central bank independence before a reform occurs. The distance from the regional mean level of this regional pressure driver is also an important one. As well as external pressure coming from international institutions, and this is mainly relevant for emerging market economies because they are often subject to IMF programs. High inflation is an important contributor to increases in central bank independence, and it seems to be followed by changes in that direction. And this is mainly the case for emerging market economies that experience a higher level of inflation. But surprisingly, or at least to me, neither financial nor sovereign nor currency crisis are significantly drive changes in central bank independence. And finally, government fractionalization, capital changes, and growth are also helping determine the change in CBI, at least for advanced economies. Now, on the asymmetric drivers of increases versus decreases in central bank independence, it seems that the status quo, the regional pressure, and the external and the broader external pressure are important to explain the increases in central bank independence, while financial crises tend to explain decreases in independence. And this is because financial crises are typically followed by larger take-up of supervisory responsibilities by central banks, which can conflict with other objectives and therefore tend to decrease central bank independence. Now, this is a really nice paper. It's an extensive work that managed to expand the previous contribution in the literature with a larger set of data, and provides very interesting insights on the drivers of these legal reforms. At the same time, when I think about it, the main questions that came to my mind is how well does this extended index of central bank independence reflect the major threats to central bank independence that have been the central banks have been facing since the great financial crisis. So what are these threats? Some we've heard already in the discussion and in the presentation. There has been an enhanced exposure to the interaction between monetary and fiscal policy over the last decade, and this has increased the risk that central bank face of fiscal dominance. Think of the dramatic increase in government debt that major countries, many countries around the world have experienced, but in particular advanced economies like Euro area, US, and Japan. and the drastic increase that followed in the share of government debt held by central bank since the great financial crisis. Now, of course, this has become dramatic and even more severe since COVID, but it started well before with the great financial crisis. But if you look at this measure of this extended index of central bank independence, you can see that it has either increased or remained stable since 2003 in all regions, also those including Euro area, US, and Japan. Another great or major threat to central bank independence over the last decade is enhanced monetary and financial interaction. The GFC has exposed the central banks to the risk of financial dominance, also because financial factors have taken an increasing role in shaping business cycles and in shaping and in driving crises. And this has also brought to the fore the risk of financial dominance and therefore delayed the normalization both in interest rates and in the reduction of central bank balance sheets. And it has also, the GFC has also led central banks to take up a greater role in supervision, which has also added pressure to central bank independence. But despite this pressure, if you look at this extended index, it has increased consistently across regions since 2007. And this is true both for the global index and also for this index that focuses on financial independence, pointing to an increase rather than a decrease in central bank independence. And finally, there has been a worldwide expansion of central banks' remit. We just heard in the previous discussion, central banks have embarked in unconventional policies that are targeted and therefore have the redistributional role. They've been asked to deal with climate change and also to be accountable for income and wealth inequality. So all this has come with very little legal changes, but enormous political pressure. And so I wonder whether there isn't a risk that this de jure type of CBI indexes may become less meaningful over time under the current threats to central bank independence. So is this distinction between de facto and de jure relevant? Well, I think it is, because politicians heavily interfere with central banks on various dimensions, as I just said, and even without legally restricting central bank independence. So there could be large de facto, but not de jure changes. And indeed, it seems that some of the central banks that face most frequent political pressures are those that have a relatively high level of, that score highly in these central bank independent indexes, like Turkey and Argentina. Now, Binder has a paper where builds this index of political pressure for a number of countries over the last decade. I think it's interesting to see that about 1% of the central banks experience a legal reduction in CBI every year, while 10% experience political pressure. And it seems that none of the main de jure central bank independence indices is significantly correlated with the variable that indicates this political pressure. So to me, it seems that a very interesting avenue for the future, possibly not for this paper, is to extend the jure CBI indexes with measure of criteria of de facto indexes rather than adding additional de jure indices. And this could be done, for instance, through text analysis of media or central bank governance speeches. Now, before concluding, let me just add two more specific comments on the surprising lack of significance of crisis as the drivers of changes in independence. So the first point is that you have three separate crises coming in your regressions, but we know that these crises often come together. So the financial and currency crisis often labeled the twin crisis, and they occur simultaneously quite often. In emerging market economies, sovereign crisis typically leads to capital outflows and may trigger a currency crisis. So I just wonder whether these separate consideration of a crisis that are related could reduce the significance of this crisis as determinant of changes in CPI. And another observation is about the nonlinear relation between the quality of institutions and the change in central bank independence that has been pointed to in the literature. In the paper, you have a dummy variable that takes the value. One is if central bank independence is entrenched in the constitution, and this reflects the low incentives that these type of countries can have for legal reforms. But I think it's fair to say that also countries that are characterized by a very low level of central bank independence might have very little incentives to take reform, because these reforms can easily be undermined. And so maybe restricting the analysis to middle range type of countries where incentives for reforms are highest could help recover the significance of the impact of crisis. So to conclude, this is a nice paper on a very relevant topic, provides important insights of on the drivers of legal changes in central bank independence. At the same time, it seems to me that these de jure indexes have somehow limited use to shed light on the most pressing questions that we're facing about central bank independence. Thank you.
Thanks very much. So now we have 15 minutes for questions. And if you want to ask a question, type the word question in the chat. So I have a question from Tommaso already.
Oh, thank you, Kevin. So first of all, thanks to the discussants. I think both Sofia and Fiorella provided very useful insights that I believe will be very useful for Davide. So one point that I had was made by Fiorella is definitely has to do with what can we really capture about central bank independence with this index, especially related to the facts of the last few years, the expansion of the central bank's balance sheets, the post-financial crisis period, political pressures. So yeah, it boils down to de jure and de facto. But this is back as a very important topic, okay? But the topic cannot be captured with the jure classifications on. My second question has to do with outcomes. So is there anything we can show? About outcomes? Not only so think of the classic old scatter plot in the Alesina and Grilli paper relating central bank independence to average inflation outcomes. There could be interesting elements given how wide is your indicator capture, especially in developing countries, but also outcomes that may not only be related to inflation, for example, indexes of financial stability. So is there anything we can do, but with a caveat in mind, right? So more and more over the years for central banks, controlling inflation and the success in controlling the level and the variability of inflation had to do with adopting a more scientific monetary policy, so to speak, inflation targeting, a way of managing expectations, communication that doesn't have much to do with the jure independence. Okay, so provocatively, one could think that possibly if one were to try to reproduce the old-fashioned scatter plot a la Alesina and Grilli, meaning relating inflation average or variability to an index of central bank independence, one could actually find a weaker relationship, but not because central bank independence has become less important, but then but mostly because to control inflation average and variability, other tools have been well beyond central bank independence, have become widespread. As I said, inflation targeting, communication, and transparency, broadly speaking, a more scientific monetary policy. So I wonder if you could just slightly comment on this.
Okay, thanks. So in the absence of any further questions, I have a couple of questions, comments. So looking at this as as an economic historian, I mean, in a sense, one thing you're doing is you're trying to explain this trend towards greater central bank independence. And whenever you're trying to explain a historical shift like that, at least when you're in the classroom to motivate the students, you say, well, this could be interests, or it could be ideas. So if it's interests, it could be, I don't know, for some reason, there's a greater interest in combating inflation after, what happened in the 1970s or whatever, or maybe politicians have an interest in shoving the blame for unpopular policies on technocrats. So there's some sort of interest-based explanation. Or it could be that contra Marx and contra Chicago, no doubt, ideas have a separate role in driving change, and it's pretty obvious what those ideas would be and who were the promoters of those ideas. Ideas, the IR people use this phrase, epistemic communities, which is just fancy IR speak for people who think the same way, and these epistemic communities, I mean, people like, I suppose, us in this instance, have most influence when their ideas are embedded in institutions like the IMF or whatever. And ideas also have most impact at times of uncertainty. So, after the collapse of Bretton Woods and inflation, how do you manage these things and so on? And ideas also have greatest impact when they're aligned with interests. So, that might be, and in a sense, all of your findings about the importance of external institutions might suggest that ideas are actually pretty important driving these things. So that might be the way that I would frame the question, but not that you should. And then if I were thinking ahead to the eventual decline of central bank independence, because nothing lasts forever, and there's a bit of backsliding, I find myself thinking of, say, political scientists who worry about the EU's democratic deficit. So an absence of democracy is always a cost, right? And so, if you delegate things to the Commission, that's not great. But on the other hand, it may lack democratic input legitimacy, but it may give you output legitimacy because you're getting better outcomes. And so we all agree that this is a good thing. So that's the first distinction they make. And then they also make a distinction between policies that are, just welfare improving, almost Pareto improving on the one hand, and policies with significant distributional impact, and they would say, well, then you really ought to be kind of getting democratic input. So that would sort of predict that you're going to see most backsliding either if the technocrats are screwing up, so it'd be interesting to know if there's more backsliding after a financial crisis, if the central bank already had responsibility for financial stability, for example, or, is there more backsliding when the distributional impacts of monetary policy are heightened or become more visible in some way? That's where you might expect to see most backsliding. So that was me. I have a question from Isabelle Méjean. Isabelle.
Yes, thanks. Very interesting presentation. So it's just a small kind of question out of curiosity. I was wondering the extent to which the EMU experience is important in driving some of the correlations that you mentioned at the end, because I would expect that this drives kind of a sizable amount of variability in your sample, at least for advanced countries, and thus it might be useful to just check, or perhaps you do this in the paper, but I think it would be interesting to see how the results look like without the EMU countries, for instance.
For sure. And I was kind of thinking about that. I mean, like for a small European country, if you join EMU and you then sign on to central bank independence, is that external or internal or what is it? It's very sui generis, isn't it, the EMU experience? Is there anybody else who wants to ask a question? We're running out of time. Going once, going twice. Okay, Davide, do you want to respond? You're not going to have time to respond to everybody's question.
Yes, I will try to respond.
Just what are the main things you want to say in response?
So the part on the EMU experience is totally true. For the baseline results are showed, including all Euro area countries, and also those that are joining the European Union. But then in the robustness section of the paper, there are also the results, excluding all Euro area countries and European Union countries, and the results remain more or less unchanged. Thanks so much for the very, very interesting comments, both from Tommaso, Sofia, and Fiorella. I think from my point of view, working on this project has been an incredible learning experience, because when I started working on it, I had the impression that de facto measures were inferior in utility as compared to the euro. And indeed, if we look at the evolutions in central bank independence, most of the reforms took place and improved central bank independence before the global financial crisis. So up until that point, central bank legislative reform were used a lot by politicians. And then with the global financial crisis, it's totally true the fact that central bank de facto independence is important. Regarding Tommaso's paper on point on the outcome, there are certainly various more ways to explore about the outcome and eventually how these indexes are correlated eventually with financial stability, also somehow correlated with Kevin. It's something that can be done, but probably just to connect with Fiorella's point, apart from this learning experience, I've learned a lot from working on these legislative indexes. And now I'm actually working on other spillover projects on the Jure. For example, she mentioned analyzing the speeches of central bank governors. This is the way to go forward. In the paper, I consider, and I clearly mentioned that I focus on legislative and the Euro indexes, because I wanted to provide this historical perspective. And if we want to try to summarize what has been so far the history of central bank institutional design, not necessarily up until today, but up until the global financial crisis, the Euro indexes were the main one. Well, all the comments, I think they will certainly be more than useful for improving the final outcome of the paper. But yeah, there will be also probably a more discussion on the limitation of this or the difference between the Euro and de facto indexes. And regarding the comment from Sophia regarding what drives the waves, I didn't test this empirically, but actually by reading this legislation, you actually realize that it is enough for one country in a region to reform, and then you will typically have the others to follow. Or otherwise, one thing that happens a lot, especially in Latin American countries, is that if we look at the data before 1972, the democratization in these countries, it was enough for one country to become democratic, and then reforms in central bank institutional design were implemented. And then there was this, like in the Arab Spring, where there is a flow and a wave of reform, democratization that is typically followed also by reforming central bank institutional design.
Okay, I think we're going to have to leave it there, Davide. Thanks very much indeed. We're out of time. So next up, well done, Davide. So next up is Naomitsu. Do you have your slides ready there, Naomitsu? Talking about something completely different.
Okay. Can everybody see the slide?
We can see you, and we can see your lovely backdrop. All the
heather. Thank you. How about
lavender? Yeah.
Okay.
Yep, got you. You're all set to go.
Okay. Okay. Well, thank you very much for giving me this opportunity to present this paper with my colleague Tomi Kira and Juha Tumala. So this paper is about interaction between new technology changes and labor market institution in early retirement. So across OECD countries and many other non-OECD countries, population aging is actually a formidable challenge, not only to economic growth, but to fiscal sustainability, as most of our countries face this increasing need to mitigate the fiscal pressure from the social and healthcare spending arising from aging. And so therefore, promoting longer working life is actually essential policy. But there are several barriers to increasing old age employment. And here we focus two topics, which is one is technological change, which is often referred to the skill bias technological change that is placed on workers engaged in codifier routine tasks, as documented by authors and several works by Acemoglu. And old workers are just more prone to such risk of being displaced by technological change than younger workers, as they have less recent skills and also weaker incentives to update their skills. And another important barrier to old age employment is the labor market institutions, namely what we focus on here is generous entitlement to the unemployment benefit for reserved for older workers. But in many cases, there are also disability benefits, which has this more lenient criteria for reserved for old people. Oops, excuse me. So what does this paper do? In a nutshell, we explore how an so-called institutional pathway to early retirement. In the case of this paper, we use Finland's so-called unemployment tunnel, interact with the technological change, in which case we focus on the digital technologies to push older workers out of employment. So for this, we match this large employer data set of Finland with the OECD indicator that is at the level of each occupation, which is constructed by the OECD survey on adult skills. And this indicator captures each occupation's exposure to digital technologies. And what we do, we estimate the probability of an older individual who exits employment, either through unemployment benefit or through disability or through inactivity, as a function of exposure to digital technology and access to unemployment tunnel, and more importantly, the interactions. So what we find is that while workers who are engaged in occupations characterized with higher exposure to digital technologies have higher risk of exiting employment, this risk is significantly magnified when the individual gains access to the unemployment tunnel. And so we estimate that the combined effect of this higher exposure to digital technologies and gaining access to unemployment tunnel increases the risk of exiting employment by 80%. And we also used our estimated coefficients to conduct a simple simulation of the policy reforms that tighten access to this unemployment tunnel. And we find that this kind of reform is relevant mostly for workers who are more exposed to digital technologies. So, and the policy implication of our paper is rather straightforward. At OECD, or I guess in every kind of policy institution, we often talk about the importance of so-called the future work. It's basically to increase the inclusiveness of labor market against workers who are displaced by technologies, and especially in case of older workers. But the straightforward message of this paper is that reform that tighten the access to early retirement pathways is actually an essential policy for ensuring this kind of inclusiveness of old workers who would lag behind in adopting this technological change. So just to give you a little bit of background, Finland is actually a very interesting country to study this kind of policy issue, because on one hand, Finland is considered as one of the most advanced country in adoption of digital technologies, for instance, captured by the European Union's digital economy and society index. But on the other hand, Finland is actually one of the country which has like most severe intergenerational skill gap. And so especially in this, they have really large intergenerational gaps in digital skill. In here, like it's demonstrated between those workers aged more than 55, between those 25, 34 years old, which actually implies that there's a significant technology-driven pressure towards the employment of older workers in Finland. And Finland also has this unique institution called the unemployment tunnel, which is a combination of the so-called extension of unemployment benefits, which starts from 61, and which is combined with a longer entitlement to unemployment benefit for older workers than younger workers. So basically, older workers can receive up to 500 days or working days of unemployment benefit, which is longer than usual entitlement for younger workers. And once they run out of this unemployment benefits, they can actually, when they run out of this benefit and they're aged 61 or older, they are entitled to this extended unemployment benefit, which allows them to keep receiving the unemployment benefit until their retirement age of 65 or age of 63, when they can start drawing early age pension. So the conceptual background of this paper is this idea of technology used in early retirement. So as numerous studies have shown, skill bias technology changes displace some workers while increasing jobs created by new technologies. But older workers are less likely to seize the new job opportunity because, for one thing, they cannot recoup the upfront cost of investing in new skills because of their shorter remaining career lifespan. And also, older workers are usually equipped with less recent skills, which are like more and more exposed to the risk of being obsolete by the technological change. And so the prediction from previous studies is that the older workers who are exposed to radical technological change may choose to actually retire early instead of investing in new skills and remain in job market. On the other hand, what we can say about technological change is that it boosts productivity, and then it boosts wage level for some workers, which could encourage actually older workers to remain longer in their jobs. So in a sense, the net impact of technological changes on early retirement is a kind of empirical question. It's a priori ambiguous. But our conjecture is that the labor, when it's combined with the labor market institution that provides early retirement pathways, this can actually tilt the impact of technological changes in favor of early retirement. And so there's rich evidence on how this unemployment tunnel in Finland actually acts as a tunnel to early retirement. Mostly papers by my course Tomi Kira, and but this kind of evidence was also found for some other European countries like Austria, for instance. And although in this paper we do not study so extensively, but the disability benefit is considered to act as this kind of early retirement tunnel as well. So our essential hypothesis is that older workers who are more exposed to technological changes are more likely to retire early whenever they have access to this early retirement pathways. Or conversely, older workers who gain access to early retirement pathways are more likely to use it when they are more exposed to technological changes. So in a sense, this paper kind of fills a gap between two large literature. So one, of course, there was a literature on how technological change displaced workers. And there was also another large literature on the impact of labor market institution design on retirement. But there were not so many studies that kind of study the interaction, how those technology and labor early retirement pathways interact with each other. So this paper, in a sense, aims to like fill that void. So I think I have to speed up. So the data that I use for this this study is Finnish employer data set, the so-called the folk data set, which is a panel covering all persons belonging to the population, which is about 5 million individuals per year. And it contains this rich information on not only on individuals' demographic and socioeconomic characteristics, but the in and out of like benefits and jobs. So it allows us to like track each individual's transition into in and out of employment as well. And so what we do is we focus on individuals between the age of 50 and 64 who are employed in the private sector. And we require that they were employed in the same firm over the past 2 years because we are interested in retirement. And since we are interested in the impact of unemployment tunnel, which is, by the way, only available for employees. So we, in a sense, that actually forces us to like exclude the self-employed employed for our company. And what we do is we match this data set with the indicator of the exposure on digital technology. And so this occupational level, we have 3 types of occupational level data sets from the OECD, which are all constructed from the OECD survey of adult skill. For those who are not familiar with OECD, so-called the PIAC study, is that this is the kind of survey that measures adults' proficiency in information processing skills, literacy, numeracy, and so on. And it also actually gathers information on the, how adults use their skill in their workplace. So this actually allows us to construct indicators that measures the risk of automation that each individual face. In the same way as the novel study, the study by Frey and Osborne first estimated the automation risk, except that our indicator is actually better than the indicator from Frey and Osborne, which was on level of occupation, whereas the PIAC study actually allows us to estimate the risk of automation at each level of jobs or tasks. We have the indicator on the intensity of routine tasks, which is also based on the information about the extent of which the workers have like, how do you say, flexibility, or like they're able to sequence their tasks. And we have the indicator on the intensity of ICT skill use, which is rather straightforward. This is based on the information that the survey collects on how often the workers use ICT in their workplace. And those indicators, as we can imagine from the previous works, the intensity of routine tasks, the higher intensity of routine tasks is often like associated with higher risk of automation. But what is a bit interesting is the intensity of ICT, the lower intensity of ICT skills is not necessarily always related with higher risk of automation, because some manual tasks, some low-skill manual tasks that requires like interaction with human interaction, such as caring for elderly, is not easy to be automated. It's not. It cannot be like programmed or like codified. So hence, like it's not easy to be substituted by robots or computers. And so what we do now is that we compare the risk of finished order workers like flowing out of employment between workers which workers in occupation which exposed with higher than average risk of automation versus those in occupation with lower than average risk of occupation. So the blue line is those with lower risk of automation, and red line is those with higher risk of automation. And you can see that when you look at the risk of inflow into unemployment, the risk of unemployment is always higher for workers exposed with higher automation risk. But the risk also start climbing faster for those workers and workers characterized with lower risk of automation. And we also see same kind of a pattern for those workers, for the risk of like workers like flowing to disability. So our empirical approach is that we identify the impact of gaining access to unemployment tunnel by exploiting the past reform episode in Finland that pushed back this eligibility age for the extension of unemployment benefit. So, so this actually allows us to create this like exogenous variation in the eligibility age of the unemployment tunnel. So in a sense, the people with exactly same age may be eligible to the unemployment tunnel or may not be eligible to unemployment tunnel, like depending on the year that they were born. And this allows us to control for age effect and still identify the impact of access to unemployment tunnel. And so this unemployment tunnel, like that we define in this paper, is actually this the combination of, as I explained earlier, the combination of longer entitlement to the usual unemployment benefit and this extension of unemployment benefit until the age of retirement. So
you have about 3 minutes left, just to say.
Oh, sorry.
Yeah.
Yes. So our estimation model is this linear probability model. And so the dependent variable is this probability of employed person like flowing into unemployment. And we on the right hand side, we include the standardized value of the indicator of exposure to technological changes, and which is a continuous value. And this dummy variable, which indicates the access to unemployment tunnel, and more importantly, the interaction. And some of the empirical issue that we have, which we are trying to address, like in our partly in the revision paper, is that the occupation, for one thing, the occupational level measure of exposure to digital technology, the three OECD indicators, do not have time variation. So it does not therefore allow us to like conduct a causal interpretation. So the impact of tech should be interpreted as a conditional correlation rather than causal interpretation. And some older workers who are more exposed to digital technologies may actually differ from those who are exposed to who are less exposed to digital technologies. And lastly, the impact of like higher exposure to digital technology may vary by age. So older workers may be like respond more to high exposure to digital technologies. For this reason, we include this interaction between the age dummy and technology variables. And so I'm going to skip this. So very quickly to the result. Actually, like since I'm running out of the time, I think I'm going to just summarize very quickly the result. So what we find is that workers with high occupation, which is more exposed to digital technologies, have somewhat higher risk of early retirement. So it increases the risk of workers exiting employment by like some little bit less than 1 percentage point. But when those workers gain access to unemployment tunnel, the interaction terms, the coefficients on the interaction terms suggest that this increased the risk of outflow about 2 percentage points. And gaining access to unemployment tunnel itself has a significant impact on increasing the outflow from employment, which is also 2 percentage points. So adding all together, it basically increased the risk of job loss by workers aged between 57 and 58 by 80%. So what we actually used those estimated coefficients from the estimation to simulate how the probability of workers aged 50 survives in employment throughout 65, and how does how to say different scenario of the eligibility age of unemployment tunnel like change this survival probability. And what we find is that if you look at this red line, those workers who are affected by the survivability of workers that are affected by this kind of reform is mostly significant for those workers who are exposed to higher than average risk of automation. So, so in the conclusion, so what we find is that our main message is closing pathways to early retirement is an important policy to increase the old age employment during this digital age. So we often emphasize the importance of lifelong learnings and adult education, but old workers would have very little incentive to take up those training opportunities if this early retirement pathway is left open. And also Finland actually implemented this, decided to actually abolish this unemployment tunnel system lately. It will be phased in like over the future. But this kind of reforms to tighten the unemployment tunnel actually increase, disproportionately affect those older workers who are more exposed to digital technology change. So therefore, it is important to, how do you say, offer this targeted training, so targeted measure to help those older workers to integrate in the labor market or find new jobs.
Okay.
And thirdly, maybe I should stop here, but I guess the elephant in the room is the COVID pandemic. And so during the large economic shocks followed by the COVID-19 pandemic, Finland introduced something called the temporary layoff scheme, which allows companies to actually lay off workers temporarily, and while those workers can receive unemployment benefit. And while we do not have sufficient data to assess the impact of this scheme, we have high frequency data that suggests that this kind of temporary layoff targeted older workers who are more exposed to technological changes, who are nearing the age of entering unemployment tunnel.
Okay. Thank you very much. Thank you very much indeed.
I didn't go too much over.
Oh, don't worry. Thank you very much. Okay, so our first discussant is Chemo. Chemo Fetzer. Over to you, Chemo.
Yep, thanks a lot. I'll just open my share. Do you see my screen?
Yes.
Perfect. Okay. Yeah, thank you so much for giving me the opportunity to discuss this paper. This is an important paper because as it was motivated, demographic pressures will require working lives to be extended. And at the same time, there's these changing skill requirements due to technological change, which sort of gradually erodes the value of human capital. And so both employer and employees might have actually incentives to dissolve a job, and they might actually complement each other. So because firms might find it optimal to lay off older workers to avoid having to invest resources to retrain them. And at the same time, older workers might want to retire, in particular if it's sort of financially attractive or the sort of disincentives are not that high. So what the paper does, it studies the interaction between both technological change and changes in the eligibility to this sort of financially attractive more pathway into early retirement, which is called the unemployment tunnel or the age-dependent generosity of the UI. So the main finding is that institutions that provide pathways to early retirement reinforce these incentives for those who work in industries with high exposure to technological change to retire early. So just to illustrate a little bit sort of how this looks, what the paper exploits is essentially, or tries to explain, is how over time there was changes in sort of the eligibility of this more generous unemployment sort of tunnel, unemployment benefits, depending on the age, and it was reformed a couple of times, moving essentially the eligibility from 57 to subsequently to 59 over time, which is of one source of variation. And obviously what the paper then tries to do is to explain the variation, in essence, the uptake, and to what extent this variation in the uptake is down to the underlying automation or occupation specific technological change or risk of technological change. As I said, in terms of the paper, it finds that these pathways to early retirement reinforce the incentives for those who work to retire early, to work in industry, but particularly in industries with high exposure to technological change. And the key element and parameter of interest here is this interaction effect between sort of the employment tunnel and the technological vulnerability of a specific occupation. There's some interesting industry sector level heterogeneity that, however, obviously is not it's not possible to interpret it causally within sort of the set of identification assumptions that are being made. So I'd like to focus some of my comments on some of the empirical questions I had about sort of the empirical approach, and also a little bit on the mechanism and the interpretation. In terms of the main concern, to me, it's actually not clear why the authors choose the specifics of empirical setup that was chosen, and not, for example, use an RDD with the eligibility age as a cutoff, in particular to complement the quasi-diff analysis that is done. I think this would seem a bit cleaner to me. There's also, it's not clear why, if we can look at the estimating specification, we're essentially conditioning on the previous 2 years employment status to look at whether somebody who was employed in the previous 2 years with the same employer subsequently becomes unemployed, and to what extent of that probability, that transition probability varies across the exposure, the eligibility for the unemployment tunnel, which is based on the individual age, the occupation specific technology, and obviously the interaction between these two. So what we will see then, in essence, I don't quite understand why, if the focus is really on the interaction, why not generally exploit within individual variation and eligibility in a proper panel setup where you can actually account for individual level fixed effect, which obviously would shift focus to the interaction and render the other two coefficients perfectly collinear, and would come with more relaxed identification assumptions. In particular, you would want to see the exploitation of this individual level variation, at least sort of in a more conventional event study setup that would also allow one to kind of comment on common trends, and also highlight potentially the vulnerability of results if one were to sort of saturate the specifications more with occupation by year or industry by year fixed effects. In terms of the as I said, I think that there's also a point about inference, which is not entirely clear to me. The variation, that is sort of exploited is really driven by age and occupation. So it would seem prudent to sort of cluster standard errors two-way by age and occupation, or depending on the granularity here by age times age by occupation, because right now the standard errors are clustered sort of at the individual level, but at some level the variation here in terms of treatment intensity, so to say, is actually down to age and occupation, which I think would make this the right level at which to conduct inference. In terms of the mechanism, I think the central question really is that I sort of think the paper can really improve on is really trying to explain whether this is about firms pushing workers out in a way that sort of works for workers, or whether it's actually workers demanding exit, potentially due to worsening outside options as they grow older. And I think the paper really could do a lot more to shape some, shine some more light on which one of these two is it, or which factors behind these two sort of mechanisms is driving the observed results, because obviously this has significant implications for how one should think about redesigning the policy. I mean, it's been abolished, obviously, as was highlighted, but also about more generally how one should think about sort of the interaction between sort of early retirement incentives and technological change more broadly in different countries. In particular, I mean, the authors kind of take a stance that essentially it's workers who want to sort of select themselves out, and it's not sort of employers who actively push out employees. But I'm not sure. I mean, Finland is an economy with not as dual a labor market as, for example, exists in other countries, where actually, the dualities might actually play in, where young workers tend to be in quite unsecure, non-permanent employment relationships, and sort of you have this sort of older workers who are protected, where the protection status itself might erode incentives to actually invest in sort of acquiring skills. So what I would really like to see is the paper really pushing things a little bit further to shed some light on the underlying mechanisms. In particular, there's a lot of sort of discussion around the effectiveness of vocational training and continuous learning, which is posited that it would be severely undermined due to the pathways to early retirement, but without understanding whether it's sort of preference-induced, worker-induced, or firm-induced. I think it's really quite difficult. It's a very strong interpretation, I think, of the very intriguing and important results. So in particular, if we think about if it's firms pushing workers out, what could be potentially possible is to think about the type of upskilling that might be required for specific type of technological shocks. Think about there might be upskilling of the type of like learning Python coding, which is very transferable across employers, or training on a very specific machinery equipment that's been newly acquired. One of them is sort of relationship specific, the other one is sort of quite transferable. And so if it's possible to sort of measure this in some way, one could actually shed some light on the underlying incentives or disincentives for firms to invest in upskilling to create this easily transferable human capital. In terms of workers being pulled out, I mean, pulling is probably a bad word, but I think it's really about understanding the incentives of workers and individuals much more sharply, where I guess the heterogeneity analysis that is being presented, shed some light in that direction, whereby the effect is particularly weak for individuals with tertiary education, which raises concerns that maybe this is really about poor outside options. The combination of poor outside options plus the incentive that actually create this demand for early retirement, which I think has different interpretation. So I would like to see more evidence on the incentives and the comparison, for example, between their income and the level of unemployment benefits and so on, to really understand the economic incentives slightly better. There's a few smaller comments. I'll just leave them here, about sort of robustness and sort of some clarification question, but I think I'll just hand over to Chris. Thanks a lot.
Thanks very much, Chemo. Okay, so Christopher is next up. Over to you, Chris.
Great. Thank you so much to give me the opportunity to discuss this really interesting work. Can you see my screen?
Yep.
Great. Okay. So this is, of course, a super important and interesting question. So basically, we live in this world where there's technology shocks. They increase the overall productivity of our economy. And then there are some winners and some losers. And so this paper is, in a sense, about this very important question, focusing on some of the losers that are older in age here. So basically people close to retirement, a group that is particularly vulnerable. And so what the authors ask is basically whether economic incentives for early retirement interact with exposure to technological change. And they have a very cool data set, matched employer-employee data set in Finland, and find that workers exposed to technological change with early retirement opportunities are more likely to exit the labor market. And because Timo and I are friends and co-authors, I'm not going to talk about the econometrics because I knew what he was going to talk about, and I will instead focus more on, say, the big picture policy questions, thinking a little bit more about how understanding mechanisms inform the kind of relevant policy questions that are related, from a bigger picture point of view to this question. So what are the relevant policy questions of interest here? So it's basically about optimal insurance design in a world of creative destruction where new opportunities arise. And as I said, some people will lose, some people will win. And it is about the consequent question of how governments should optimally provide incentives to older workers to invest in their human capital, to potentially increase their outside options in response to technological shocks. And this is something that isn't really discussed in the paper, and that's kind of an implication, more of a corollary, how the government should optimally provide incentives to firms to invest in the human capital of their workers. And I will first ask a few questions about the context, which I think are kind of important to better understand. And I think this is now some comments basically on the exposition of the paper that could be improved. Just basically, I thought that it would be nice, also for the presentation, to give more context on the kind of jobs and what kind of technological change is going on here. I think what is really important, and Timo talked about this briefly as well, is understanding the outside options of these workers. What are these jobs? What are the outside options that these workers would have? Could they stay in the same industry? Could they stay in the same firm? Would they have to switch industries? Would they have to switch employers? All of this context, building a little bit more context here, I think will be quite useful. How large are the returns in investing in these in the human capital of these workers? Is this even does this even make economic sense? Do we have good estimates for that? I think it would be nice to kind of discuss relevant evidence we have on these types of interventions, and trying to understand in how far new outside options can be created for these workers. And so this also comes back to the point that Timo raised. So basically, I think all of the policy conclusions will hinge on the nature of exit from employment. Why are those people leaving? Are they being fired, or are they voluntarily leaving? Are firms more likely to fire these workers because they know that the workers are insured? I think understanding these dynamics a little bit better, understanding, again, through some more qualitative evidence, the nature of these exits, I think, will be quite useful. And so, just some ideas on how you could get at these issues. Do you know whether these people are still searching for jobs? Are they still, what are the reemployment probabilities, or are they really just, basically early retiring? And do they want that? Would they actually prefer working, or do they have other, non-work tasks that make them happier than work, right? So I think all of these questions are important for understanding welfare. So one other thing that I wanted to flag is that, of course, from thinking again about the policy conclusion, what will be critical here is understanding basically the impact of an insurance scheme also on mental health. Basically, the insurance scheme. So the way the paper is written up, it really says welfare is just defined by the overall employment level. But of course, we all know that insurance is good because it removes lots of uncertainties for people. And so, especially in this world of rising inequalities, providing insurance is essential. And so, I was wondering, and I'm not suggesting that the authors do this for the paper now, but I'm just more broadly thinking about what are the consequences of this exposure to technological change on mental health, are those people more exposed? Are they more stressed? And how does the early retirement help? I mean, is it is it that the early retirement actually helps deal with some of these adverse mental health shocks, or well, it might also not even would help. The other thing relates to the point about whether it's productive and viable and feasible to invest in the human capital of these workers. I was wondering, whether there's interesting heterogeneities you could exploit based on the Finnish data. So the Finnish data has this exciting feature that, at least for all men in the data set, there's rich information on IQ. So for example, understanding a little bit, could you match that IQ data to your data set and understand, in how far, the willingness to do these additional training programs and these exits, are related to workers' cognitive abilities. And there's some references in the slides that give you a hint on the kinds of papers that have employed that match between IQ data and this admin data. And so basically, now summing up, I think the policy conclusion needs to be more nuanced. So, when thinking about optimal insurance schemes, so we should think about the welfare of workers and their families, about the firm's profits and their survival, because, these policies will also affect, firms' inclination to fire these workers, or, it will affect firms' profits because these workers might not be productive anymore. So, they don't have to employ them anymore. And it will affect government finances and thereby taxpayers. And I think the paper should, at the very least, discuss that there's more to, there's more factors underlying, policy than just the government finances and the overall employment rate. Exactly. So I think one question that is very important is, to think about exactly the outside option. Are these people going into activities that other types of non-work activities that are actually productive, like taking care of grandchildren or doing voluntary work outside the formal economy? And I think basically it would be really important to understand how productive these workers are in these different counterfactual scenarios, and how costly it would be for firms to keep these people employed versus not keeping them employed under these counterfactual insurance schemes. And then I was wondering also whether there would be ways to understand whether these workers that are exposed to technological change, whether, how costly it is for firm if they exit or not, or how maybe even beneficial it is for firms if they exit or not. So I was thinking that maybe the, research design on worker deaths by Jäger and Heining, you could basically put heterogeneous effects of that kind of design, where you study how costly it is for firms to basically replace workers or not if they are either exposed to technological change or not. And so yes, so basically all in all, this is a great question and a great data set, and I really want to emphasize that I'm super intrigued by all of this, but I want to kind of caution for a somewhat more nuanced policy conclusion and a bit considering not only the overall employment level but also issues such as mental health, firm profits, and the broader implications, taking into account the outside options of the workers.
Okay, thanks very much indeed, Chris. All right, so I have 5 questions already in the chat, so I think we'll just take them sequentially, and we'll leave Namito, maybe a minute or two at the end to respond very briefly. I'd like to end by 1:55 at the latest, which will be 5 minutes late. So the first question is from Lorenzo.
Hi, everyone. Well, thanks a lot for the very interesting presentation. I just wanted to ask if you can say something about the implications of this early retirement program for yacht employment, basically. So in this case, I just wanted to ask if, the other side of how this program affects the entry of young workers into employment in these industries, which are more skill intensive somehow. Thanks.
Thank you. Okay, Ghazala has a question.
Yeah, thank you. Thanks for a nice presentation and for the two really nice discussions. Actually, I mean, I think what I wanted to ask is kind of being covered quite well in the discussions. I think it was really spot on that it's really important to think about the policy conclusions, and for that kind of getting at the mechanism, and in particular trying to really understand the role of the firm. It would be really nice if you can do something more on that. And then also, and this also links to some of the discussion as well. I mean, can you actually look more directly at what these workers are doing when they retire? So, you know, for example, are they actually enrolling in training programs? Can you look into this? Or then, you know, what else are they doing? Are they still actively searching for work? Are they going into inactivity or doing other types of jobs?
Thanks very much. Dennis.
Yeah. Hi. Yeah, thanks for the presentation. This is a very interesting question. I was gonna underline this point about heterogeneity analysis that actually both discussants, both Timo and Chris made. If I understand correctly, you have over 600,000 individuals here that you track over multiple years. So this incredible detail that you could exploit, and in particular, if I understand it correctly, you also have information on housing and family, which I haven't seen. So you looked at male, female, and the education levels separately, and so heterogeneity. I wonder whether you can say more. No, I don't know what exactly you have in the data set. And then related to that, if I understand it correctly, I might be misguided, but this is an employee-employer data set. So I was wondering if you know anything about the employer, could you just throw in fixed effects, firm fixed effects? This would obviously be a lot of fixed effects, but if you just do a linear probability model, you probably have to throw out a lot of workers, but there's a lot probably that you could squeeze out of that, if that's possible, to see whether it's really driven by firms or whether it's not. Thank you.
Thanks very much. So next up is Moritz Kuhn.
Thank you. I think the paper makes a super important point, namely that whenever we do like labor market policies, we should not only think about people finding jobs and like what has also been emphasized very much during the discussion, like about the outside options, but also about like people staying in the job. So outflows from employment. I think there the paper makes an extremely important point, and we have like a lot of evidence about that this is very important throughout Europe. I was just wondering about what you said in the beginning and how you motivate it. It's like, is it really the case that these sectors or occupations are shrinking because people are leaving them, or is it all about inflows? Is it just that some sectors are going to shrink because there are fewer younger workers going there? So is it really about technological change leading to people leaving a sector or an occupation, or is it about fewer people going to enter there? And I think related to this, you showed all these information about the skill gap and the institutional design. That it's not like, I would always think about these two things being determined together. If someone tells me I can like lay off all my 55-year-old workers and society is going to pay for this, obviously I'm not going to train them. So the skill gap, I think, is very much endogenous. And I think also it would be important that you discuss a little bit about employment protection legislation. So could a firm just lay off workers if they become unproductive, or what would otherwise happen with these workers? Like, my impression is that typically if these like very generous transfers from society towards these employer-employee relationships would not happen, these people would just keep on working. Thank you.
Thanks very much. And next up we have Roland.
Yes, thank you very much. It was a great presentation and also amazing discussions that, you know, cut a lot of what I wanted to say. So I'm just going to stress the last point also made by Chris about the welfare implications, because it really strikes me that it's really central to be very clear about what the welfare implications of the reforms are indeed. And in particular, I mean, the thing I was thinking is really the training costs, right? So it's been already mentioned by Chris, but basically, the training costs are borne both by the firm in terms of financial costs and in terms of cognitive costs by the worker. And then there could be a very short horizon to actually roll these investments. So they are really, I mean, it's really not clear what's optimal in this case. So I think it really deserves to be not only nuanced, but I think discussed much more. Thank you very much.
Thanks very much. Are there any other questions? No. Well, I mean, so in that case, I think Naomi, so you can respond briefly to this. And thanks to all the questioners for keeping your questions short, so we can actually have a fairly long break, hopefully. Yes. So Naomi, so over to you.
Thank you so much for the great comments, and woof, but that's a lot to digest. Perhaps I should start with this welfare implications. So, so first, what do those people who enter the unemployment tunnel do? So since this is how do you say, unemployment benefits, like just like in unemployment benefits in other countries, workers do have activation, how do you say, obligations. So like they should be looking for jobs. But one of the problem in Finland is this activation requirement for older people is de facto very lenient compared to the activation requirements of younger workers. So in that sense, they are like, how do you say, in theory, they are looking for jobs. But in fact, they are almost like in inactivities. It's hard to like discuss the welfare implication of that kind of state. So another important question is whether are they being fired early by firms, or like they're actually voluntarily entering the employment? There's a bit of both, but there also works. There also works that actually found in the past that there was a reform which made it more expensive for firms to let go of their employee early and let them enter the employment tunnel. Like it's called, it was the introduction of the so-called experienced rated payment contribution to the unemployment fund, which was on the side of the employer. So like when its employees tend to leave early to unemployment tunnel, the firm has to pay higher like premium for the employment fund. And what did this reform do? It actually increased the demand for employment. So in that sense, how do you say? In that sense, it seems that there is actually, how do you say, incentive for firms to like keep the employee longer. But employees are actually leaving whenever they have the chance. Not necessarily because the working environment is stressful. There was this benchmarking, international benchmarking, which suggests that the stress level at the workplace in Finland is not high compared to other OECD countries. Although Finland's work arrangement could be a little bit less time flexible than other countries, which could be actually indicating that the older workers want more flexibility with their work arrangement at their older age, perhaps because they want to take care of their grandchildren. And the current work arrangement just does not allow that. So they just take the outside option and enter the employment tunnel. About the training, Finland overall has like a rather high enrollment into how do you say, adult education or lifelong trainings. So in that sense, the cost of training older workers should not be how do you say very high because they don't really start from a very low level. But I think it is more of a, how do you say, incentive issues than how do you say the issue of like the cost of training or something. That's why it's that kind of highlights the importance of reforming this unemployment tunnel, because Finland, just like other OECD countries, are facing like severe skill shortages, and this employment tunnel is actually pushing those workers who still have like relevant skills to actually go into retirement. And I also thanks this very important comments on our empirical strategy, and we are actually going to include the fixed effect model in our revision. We also considered about the regression discontinuity design, but we actually could not, because we did not have disaggregated data on the birth date on the individuals. We only have the years. So I guess if you want to do the regression discontinuity design, we want to have also the data on months, but those are not the information that we just had in hands. Perhaps my co-author Tomikira or Juha may want to add something on the analytical approach very quickly.
Yeah, we're going to stop in 1 minute, so okay. he or you have 1 minute.
Okay, thank you. So we are actually, as now pointed out, we are doing different kind of empirical approaches. We are experimenting with event study type approach to show that there are no pre-trends, and we can do this regression discontinuity thing also, but that will take some time in order to apply the exception in order to get the data for detailed birth dates. So everything is under work. Okay,
very good. That seems like a good note on which to end. More work, always good for the soul, everything else. So thank you very much. We now have a 15-minute break, and we'll be back at 3:10 continental time, Brussels time. Thanks very much.
So we are Swiss punctual then.
Just. Okay, so let's start. Ryan, we are very happy to listen to your paper about corporate zombies. Please.
Thank you very much. I'd like to also thank Moritz for putting us on the menu today, and also to the 3 referees for the really great comments that definitely help improve the paper, and those referees would know, they would see as we go through the slides where we've some of these are where we incorporate a lot of their comments. Okay, so let me start. So there's been an exponential increase in COVID. There's been an exponential increase over the past few years in zombie firms too. So this is a graph looking at the number of times the term zombie firms or zombie companies appeared in the media since 2005 in English, French, German, Italian, and Japanese. And as you can see, there's this exponential increase. You'd also, the number of times that Boris and I are contacted by people in the media or in financial institutions about this too, there's certainly a lot of interest in the topic. So let's just explain briefly where we fit in the literature. Well, the literature has focused on the causes and consequences of zombie firms. In terms of the causes, there are papers looking at how weak banks cause zombie firms or contribute to the zombie firm problem. There are other papers about how low rates and loose monetary policy also contribute to the zombie firm problem, and there are papers that mix the two. Then there are the papers on the content, and then a lot of these papers look at the consequences. The consequences include the congestion effects on healthy firms, dragging down productivity in the economy. More recent paper on how zombies contribute to the low inflation problem. And then there are some other papers that say, well, supporting zombies, particularly in a downturn, might not be a bad thing. But somewhat surprisingly, less is known about zombie firms themselves, and less has been sort of documented about them. And so that's what we do in this paper, and we go beyond just saying that zombies are less productive than their non-zombie peers, and want to find out a bit more about them, their anatomy and their life cycle. So let me just briefly explain the data, because I think it's important to sort of, where our contribution fits in the literature as well. We use firm level data from WorldScope. That we have around about 32,000 publicly quoted non-financial firms. They're from, our sample covers 14 OECD economies. And one of the benefits of using publicly quoted companies is we get data over a relatively long period. So we have data from 1985. This spans several business cycles. So our paper has a sort of a longer time series than other studies. Usually the previous studies only had about one business cycle. We have several more. And of course, by using data from publicly quoted firms, we also know information about expectations of future growth opportunities revealed in equity valuations, which is which can sort of help address some of the critiques of previous papers. Of course, a disadvantage is that the firms in our data set may not be representative of the total population of firms, though they do generally contribute a large proportion of the productive capacity of each economy. So let me just spend a little bit of time saying how we define a zombie firm, because this is a contribution of our paper. So there's a sort of a loose definition that people may have in their minds along the following lines: that a zombie firm they are unprofitable firms that remain in the market rather than exiting. Now, what we do in particular is we extend a backward-looking profit definition that's often used in the literature, and we include a forward-looking component based on market valuations. One of the critiques of many of the other definitions is that Tesla, an older company that had made persistent losses, would have been constituted a zombie company. Now, Tesla is many things, but it's hard to say that it's a zombie company. So then let's see what we actually. So our definition is designed to use the market's expectation about the profitability of the firm and not rely on such backward-looking indicators. So we classify a firm as a zombie if over 2 years its interest coverage ratio is below 1. And then our innovation is the second part, is that the market value of assets to replacement costs, the Tobin skew, is below the median in its sector in a given year. We choose to have a time varying point, so that it's relative to its sector in a given year, because in equity markets, there are these sort of up and down cycles where risk premia move valuations around. And it's been shown that in the cross-section, equity markets are good at pricing the cross-section of firms, maybe not necessarily in the time series. Now, after speaking to journalists and people in the financial sector, we amended some of our original definitions, some of our original ideas, by including a bit of persistence in the definition of a zombie, exiting from a zombie status. And in particular, we require a firm to have persistently either profitable, or it can pay its interest payments out of its earnings for 2 years, or its Tobin skew is above the median industry for 2 years. What we had seen when you look at the data is that there are some firms that are persistently weak. They have 1 year of profits and then they remain persistently weak, and want to avoid that kind of we wanted to keep the spell being the same spell when there were just these temporary improvements. But let's go to some of the facts about zombies then. So the presence of zombies has increased significantly since the mid-1980s in our data set. And what we're showing you here is the share of zombie firms in public, in the zombie companies in public firms since 1985. What you can see is that the share of zombie firms has risen from just above 4% in the late 1980s to around about 17% in 2020. The black lines here are business cycle peaks, and what you can show then is that in the wake of recessions, the share of zombie firms rises, and it never quite falls back in the subsequent recovery. And so the share is ratcheted up with each business cycle in our data set. Now let's turn to the anatomy of zombie firms and tell you a little bit about who they are. Well, there are a few facts here. I'm just going to a number of facts, but I'm going to focus on some of the most important ones in this slide. The first one is that zombies are smaller than healthier firms, and typically they're around about 1/3 of the size, whether you measure it by assets, capital, physical capital, or by employment. They're less dynamic. They tend to invest less in physical capital and intangible capital, and they have weaker employment growth. They're also less productive. So they're about there, whether you look at labor productivity or total factor productivity, their productivity is around about half of their non-zombie peers. So that's on the sort of on the real side. Now let's look at the financial side. Then, despite them being less productive, the interest paid that these zombie firms pay is actually indistinguishable, almost indistinguishable from their non-zombie peers. So there seems to be this idea that necessarily not subsidized credit, but credit is certainly cheap despite them being more leveraged, and there's significantly higher market leverage. So basically they are less dynamic, they're small, less dynamic, less productive, but despite being more leveraged, they seem to be getting relatively cheap debt, cheap credit. So that's the anatomy. Now let's turn to the life cycle dynamics, and I just want to explain how we look at the life cycle dynamics in this simple local projection here. We regress a characteristic of the firm, say total factor productivity of firm I in country C in sector S in period T from T plus H, when T goes from -4 to 0 in the years before they became a zombie. 0 is the year when they become a zombie, and then 1, 2, 3, 4 years after we classify them as a zombie. We regress that on a country time fixed effect, a sector time fixed effect, and then an indicator variable taking the value of 1 when if the firm became a zombie in that year. Now, of course, then we want to compare the zombies to the healthy firms, so we need to get rid of the firms that are already zombies in the year that this firm turned into a zombie. So we include a dummy variable to dummy out those pre-existing zombies. And finally, we include a firm level of control. We include actually firm size in year T minus 5, so in the year before we start our local projection, because as we saw, there were big size differences, and the literature has often shown that there are important differences by size across all of these variables differ by firm size. So we want to just control for that factor. So now with that in hand, with understanding the regression we're going to run, let's have a look at the life cycle of zombie firms, and let's look at the real variable first. So firstly, 0 is the year in which we classify a firm as being a zombie. And 0 on the y-axis is the level. You can think of it as the level relative to a healthy firm. So what you can see here is that even before a zombie firm, we classify a firm being a zombie, its productivity was below that of a healthy firm. What we find is that zombies' performance deteriorates several years before we classify them as a zombie. After we classify them as a zombie, you see that they really shrink quite dramatically. And in another example of their shrinking is the asset disposal increases relative to non-zombie firms. This shrinking of the firm, of course, moves them back along the production function, so they get reduced capital, and it helps improve the marginal productive capital, and so our measure of total factor productivity of these firms improves as well, but it never recovers and it never reaches the level of their non-zombie peers. Let's turn to some financial variables that we look at along the life cycle of zombie firms. Here I'm going to focus on what happens to debt growth and on debt variables. So firstly, what happens is, as we saw that they were hitting a sort of a TFP seemed to decline a few years before. What happens is that when they have this cash flow shock, they initially borrow. So it's sort of almost as if they think it's going to be a temporary cash flow shock. You think about what firms are trying to do during COVID. It's a temporary shock. We're going to borrow to get us through it. But it seems as if they soon realize that this may be a little bit more permanent, the cash flow shock, or a little bit more persistent, and then their debt growth, then they start trying to reduce debt. So correspondingly, when they start, their market leverage increases in the years before we classify them as zombie, and then slowly declines as they try to as they try and shrink their debt. Now let me now turn to so that was in the intensive margin. These were for firms that continue to exist after 4 periods of being classified as a zombie. So we saw that they were shrinking. So the market is working in some sense. Now let me turn to the survival of the zombies now to sort of thing on the extensive margin. So another COVID reference here. So this is these are these Kaplan-Meier curves. We've seen lots of these comparing BioNTech's treated versus non-treated groups and how effective they are. Here we're comparing how long a firm stays before either dying, being taken over, or ending up in an M&A. And what we find here is that, and for this we have the red line is what happens to is a survival rate of non-zombie firms, and the blue line is the survival rate of zombie firms. And what you can see is that for the median, looking at medians, we find that the zombies survive for about 12 years before exiting, while a non-zombie survives for about 15 years. So, and these are significantly different when we do a log rank test. So again, that the zombies are more likely on average in our sample to over the entire sample to exit than a healthier firm. Now, how long does a zombie stay in this state? And we track the firms for how long they stay in the state using similar methods. We find that the median zombie firm stays in that state for around about 7 years. So a relatively persistent period of time. Now, in our previous work, one of the things that we were often asked is, well, it's all very well talking about zombies rising, but it may be, as long as they recover, it may be okay. And so I'm going to start going into what happens to zombie firms over their life cycle and think about recoveries and deaths. So what we've plotted here is, again, kind of a COVID analogy here is we've seen a lot of measures of cumulative cases of COVID and how many have recovered and how many have died in active cases. So we do the same with our data with zombie firms, and we take the cumulative cases of zombie firms. We have around about 12,700 in our data set. What we find is that around about 60%, about 8,000 odd firms have actually recovered from that zombie, so we would no longer classify them as zombies, and only 25% have actually died or have exited the market through M&A, death, or through a takeover. And so this raises the question: if there are so many recovered zombies, is there a zombie problem or just an illusion? Well, unfortunately, it seems as if it still continues to be a problem. But what we find is that recovered zombies remain weak. And here I'm going to show you two dimensions along which they remain weak. So in this graph, we show the probability of entering zombie status conditional on either you've never been a zombie before that date, or you're a recovered zombie. And what you can see here is that that if you're a recovered zombie, you have a significantly higher probability of relapsing into zombie state. And overall, unrecovered zombies they still remain less productive than firms that have never been zombies. So they may recover, but they're not really ever catching up to their peers, and they seem to remain weak because they seem to have a higher likelihood of re-entering zombie status. Now the final slide before I conclude is on we saw at the beginning we saw this rise, this sort of shift up rise in zombie firms over our sample period, and now how has this increase in zombies, corporate zombies, arisen? And what we find is that financial pressure is likely to be reduced financial pressure is likely to be one of the explanations, and particularly since the early 2000s. And if you think actually the Greenspan put and things like that were all coming out, people were talking about these things about around that correlated that era with a change in this era. So firstly, what we do in this graph is we look at how so again, 0 would be if you're a non-zombie firm, and we look at the various metrics of zombie firms, and we look at how they were before 2000 and how they were after 2000. And what we find is that in terms of profitability ratios, there's been a marginal improvement in zombie profitability, but they still remain far weaker, less profitable than their non-zombie peers. Despite that, the interest paid on their debt, which used to be significantly higher than non-zombies, has actually declined and is now indistinguishable from healthier firms. Secondly, the pressures to deleverage also seem to have waned. Previously, zombie firms would, before 2000, zombie firms would deleverage at quite a strong rate a higher rate relative to non-zombies. Whereas post 2000, that rate of deleveraging has almost converged to what's happening to healthier firms. And finally, a sort of equivalent you can see is that their rates of asset disposal have also declined. So certainly this circumstantial evidence to suggest that reduced financial pressure seems to have there's evidence of reduced financial pressure on zombie firms. In the paper, we also then do some other tests to look at this problem, and I'm not going to show it to you here because I wanted to not go into all the details and keep it short in 20 minutes. Is that we find that lower interest rates go hand in hand with a higher share of zombie firms in sectors that are more dependent on external finance. So the idea behind this is the following: is that if it's due to reduced financial pressure that's causing the rise in zombie firms, then who's that going to affect more? It's going to affect the firms that are more dependent on external finance, who are going to be most susceptible to that. And so what we find is that indeed that's the case, that when interest rates fall, that we find that there's an increase in zombie firms in sectors that are more dependent on external finance. So with that, I'm going to conclude. Our main findings from the paper are that the share of zombie companies has increased from around about 4% to around about 17% in 2020. The share of zombies rise with recessions. They seem to fall somewhat afterwards, but they do remain higher than they were before the recession. Zombie firms are smaller, less productive, and less dynamic than other firms. And during their life cycle, zombies shrink and productivity improves, but it never reaches the levels of their non-zombie peers. The majority of zombie firms manage to recover, but closer inspection reveals that they remain weak. And finally, reduced financial pressure since the early 2000s appears to be one factor enabling zombies to persist for longer. With that, I'll leave it there.
Thank you, Ryan. Very nice. So Federica, happy to listen to you.
And can you see?
Yes.
Okay, so first of all, thank you very much for giving me the opportunity to read this paper. I didn't know anything about zombie firm, and now I know quite a lot. And I think I also learned a lot, that it was very interesting. I think this is the only occasion in my life in which I'm going to discuss a paper about zombie firm or doing something like that. So I'm sorry with the author, but I put all the possible GIF and the funny stuff because it will never happen again to me, okay? So this is a very scary paper because it's a paper about zombies, right? You need to be scared. It's also close to Halloween, so I think it's very topical. And on top of that, I think it's also scary because what they say, what is their message? Is like, oh, we have a lot of zombie firm. So what the author do, they define the zombie as firms that have, you may think Tobin Q, the Q Tobin, like Tobin Q below the medium average within each sector. So they restrict themselves for 50% of the firm within each sector. And then they look at this interest rate coverage, right? The idea is that if your profit is lower than the interest rate times your debt for more than 2 years, then you're a zombie firm. And then they analyze the anatomy and the characteristics of the zombie. So I'm not going to do a discussion in which I'm going to repeat everything because I think that Ryan did a great job to explain everything. So what's the problem of the paper? Not the problem of the paper. The problem is that zombies are very much alive and they're around us. So it seems that there is a big share of firms that are zombie and that we need to be scared about it. Now, here I have some comments and now I'm going to the serious part is that I like the paper. I like a lot what they're doing and also see that, from the referee report that the paper is very well done. It's also super easy to read. So it's like, but I have some issue about the definition, so I'm going to ask some question about that. So the first comment is that, and in some sense is addressed in the paper, so I want to be fair, is we should be interested in the share of the zombie firm or we should be interested in like the output or the employment. So how much? So if I look and say, okay, if zombie firm like were 4% and now it's 16%, but if there is only one zombie firm that produces 90% of all production, right, then this is something very scary. But if these zombie firms are producing a sort of like smaller part of the output, or they account for a smaller part of the employment, maybe we should be less scared. So it would be nice, together with this graph with respect to the share, to have something similar that also can say to us, what about the production? What about the employment? And I understand that you don't want to capture these when the firms is a zombie, right? Maybe you want to capture this 2 years before. It's something just to give us what is the size of the market of this firm? Are these big? I mean, you say that these are small firms, right? But were this small firm even before, or like they were big firms and then they like shrink and then they become zombie? Now, the second problem, or the second comment, and I don't want to say problem, is that what you observe here. So it's like Ryan didn't show this graph, but so here you have like for each sector, they give you what is the fraction of a zombie firm. Now, bear in mind that we are focusing on 50% of the firm, because we are focusing on firm below the median. And they are like, for some commodity or for pharmaceutical sector, almost 40% of the firm are zombie, right? So this means that when you like look at the Tobin Q below the median, all the firms are zombie. So all the firms have an ICR that is below 1. Now, in this case, I think that just for some sector, it may be that this is how the sector financed themselves, right? Now, after this pandemic, everybody know quite a lot about pharmaceutical sector. So we know that, for example, in the pharmaceutical sector, there is a lot of research and development. So it may be that you can have like small profit for subsequent year, and then maybe you get your patent and you get something that is very big, like a huge profit. So in some sense, it's like maybe more long term. And so I don't see how you can define this firm as zombie, or alternatively, another like big problem is in the commodity markets, right? Where you see that firms are very much, they depend quite a lot on the price. And again, now this firm here, I see that like all the firms that are below the median, they're zombie. So I think that with this criteria, I'm not an expert, but in some sector you have like some sort of problem, and it could be nice if you can like look at, for example, the firms that have a Tobin Q that is above the median, just to see whether they also have an ICR that is below 1, just to check if there is like some sector specific component on how the sector financed themselves. Now, the third comment, and I think this has also been raised by a referee, is I understand that you want to compare the zombie with respect to a non-zombie, but is this a fair comparison? Because we already know that you're like dividing the data set in below and above the median. It would be, I think, like, at least for me, this is personal taste, more informative to understand what is the difference between a zombie firm and a firm that is barely non-zombie firm, more than a zombie firm and all the rest of the firms where, for example, there are like super wealthy and super healthy firm, right? So in some sense, I do not understand completely the comparison, or better, I don't understand how the comparison is driven by the fact that you're dividing the data set in two parts, below and above the median, more than this is a zombie and this is not a zombie. Then this is like a question, Mosaic is the most stupid question I'm going to ask, but I'm not in the sector, so I don't understand how the fact that this zombie firm do not exit. I mean, if maybe some of these zombie firms, so you can see here the probability of exit between a zombie firm and a non-zombie firm is quite similar. I mean, it's like, yes, it's the double, but it's not. And I'm wondering if, I don't understand if we should be worried about that, or if just it's normal that zombie firm and non-zombie firm, they have like a similar probability to exit, conditional that we are like speaking about very unhealthy firm. Now, the last comment, and then I'm going to finish, is that I think that the impulse response function that you presented, they were super nice and super interesting. However, I understand why statistically you want to focus on the subset of firms. So maybe you didn't say in the presentation. So all the impulse response is a subset of firms that were zombie but didn't exit from the market 2 years after. So in some sense, we are like restricting our analysis on zombie firm that at the end didn't exit the market. And maybe here we're losing something, because it seems that these firms, as you were saying, I mean, to say differently, in the top of my mind, I think a zombie firm is a firm that is not very productive and is relying a lot from external financing. But here it seems that these zombie firm, they're actually selling a lot of the assets in the market and they're decreasing their leverage. So I don't know, it's like, again, because maybe I'm not in the literature, but I would think that the zombie firm are the one that rely, I don't know, on bank financing and they're very unhealthy. But here it seems that you're also capturing firms that maybe like for a few periods they have a bad shock and they're like just selling their asset in order to smooth their bad shock. And maybe they're still healthy. Again, I'm not. So it would be nice maybe if you can include some analysis in which there are also the firms that actually exit the market. So maybe these are the firms that instead they have too much debt, or they have some other kind of problem. Now, to conclude, I think it's a super interesting paper. I really learned a lot about that. My personal, impression is that I think the paper a little bit, it underestimates the amount of zombie firms because you don't have the small firms. But on the other side, I think, for example, with the sector, within each sector, sometimes you overestimate the amount of the zombie firm. I think this is a positive news because I think still I believe that there are many zombie firms that are there, but maybe there are not so many as I think the paper described. Thank you very much.
Thank you, Federica.
Stop share.
So Farzad, I hope you also have nice movies to show us.
Well, no, I left this entirely to Federica. Otherwise, I would have used the usual images from Michael Jackson's Thriller, I guess, which everybody does for talking about zombies. But I won't. Let me be very brief. Thank you for the opportunity to discuss this most interesting paper, which, unlike the literature, actually focuses on the evolution of zombie firms across countries over 3 decades. The literature, in contrast, focuses on the spillovers from zombies to non-zombie firms. And it does so just to motivate this in order to gauge the impact of zombie congestion on capital misallocation. But this paper takes a different route. It wants to understand the evolution of zombie firms, the anatomy of zombie firms, if you will, by exploiting data from different countries and over a relatively long period of time. The first question I would like to raise, though, is that whether these findings can be viewed in isolation of competitive effects. That is, the authors document that there is a lasting effect of being a zombie. It's an absorbing state, if you will, once a zombie, always a zombie. But they yield this finding of a subsample of the firms, those that are publicly listed, right? And Ryan has been very clear about this. The authors are also clear about this in the paper, but this means that in order to ascertain the external validity of the author's findings, one has to wonder whether they also hold true in the sample of firms that they do not see. In this case, small, unlisted firms that are not listed. They are privately held firms. Now, the authors argue that such small and medium-sized enterprises are more likely to be zombies, but less likely to be listed, and therefore the zombie share they document can be interpreted as a lower bound, which seems like a reasonable assumption, if you will. And it also explains some of the cross-sector heterogeneity of the document. For example, across countries, it can explain it across countries through the underrepresentation of SMEs among listed firms in continental Europe and Japan, as opposed to the other economies that they're considering. It could also explain the heterogeneity over time. For example, they show that the impact of the great financial crisis on the zombie shares is larger and more persistent than that of other recessions. So can competitive effects maybe explain these comparative statics? For them to do so, there would have to be feedback effects from small firms that they do not see, that they do not observe, to listed zombies versus non-zombie firms, right? if these feedback effects existed, and it's up to the authors to maybe argue to what extent they may or may not exist, they would affect their estimates, and the extent to which they would do so depends on the firm's size distribution within economies, which should actually also vary across the countries that the authors are considering. In particular, any such effect should depend on the degree of granularity of the origins of aggregate fluctuations in Gabek's parlance, if you will. So the relative importance of the largest firms in the economy, where it's very few large firms that drive all of the aggregate fluctuations, or mass of many small firms. Think US versus Germany, for example. In Germany, it's the origins of aggregate fluctuations are less likely to go back to a few large firms, as is the case or has already been documented for the United States. These types of considerations also matter for the higher exit rates that the authors document for zombies. Namely, they define the exit rates are also given by takeover events, and the firm size distribution within economies, and as such the differential recordability of these firms in the data could also explain some of these takeover effects that they're documenting. We need to understand which firms are actually out of the data set that could in turn affect these exit rates for zombies, for example, by making takeover offers. I will wrap up with a couple of remarks on the estimation strategy and the characterization of zombies, which comes up inadvertently in all of these discussions. So first, short on the zombification dynamics, as the authors state themselves in the paper, looking at the future is more interesting than looking at the past, because the definition of a zombie firm is a function of past observables, right? But in their estimation, I was wondering why the authors are not including even more granular fixed effects. Because, for example, it could be worthwhile to control for time-varying unobserved heterogeneity at the country by sector level. And lastly, it may pay off to also interact some of the variables with the share of zombies in a given country by sector cluster in a given point in time. Now, coming to the identification of zombie firms that Federica also alluded to, when it comes to the zombie literature, there are as many definitions as there are shades of gray, almost 50. Here's a little overview for you. It started out with the Caballero et al. Paper, where they considered firms that obtained subsidized credit, and even that measure has already been criticized. The future growth potential goes back to the authors actually themselves, who are proven experts on the subject. Then Fabiano Schivadi and co-authors, they consider profitability and leverage. And lastly, we have debt servicing capacity from a very important OECD working paper. And this is indeed what the authors are also using. Typically, one would use the interest coverage ratio as a measure of debt servicing capacity. The interest coverage ratio is a ratio between the firm's gross operating profits, if you will, over total interest expenses. And the authors are considering interest coverage ratio after depreciation and amortization of below 1, in conjunction with an indicator for below median Tobin's Qs. Now, I was first of all just plain wondering whether it's innocuous to combine here an absolute criterion, less than 1, with a relative one, which is a function of the distribution of Tobin's Q in a given sector by year cluster. Just open question, really. Second, regarding the definition of the interest coverage ratio, the authors use EBIT and not EBITDA, and I just wanted to raise an issue with using profits after depreciation and amortization, because that might lead to falsely labeling firms as zombies that invested heavily in previous years and amortized that investment quickly. This point has been made perceptively by Giacomo Rodano and Enrico Sette in 2019, and it might actually affect the author's zombie definition very much, especially in light of their cross-country evidence, because by bringing in EBIT after depreciation and amortization, the authors are also bringing in all kinds of different tax regimes, accounting regimes across these countries that they're considering. So it may be worthwhile to replace EBIT by EBITDA. Now, the authors also have this neat analysis on recovered zombies that have naturally a higher probability of relapsing than do firms that were never zombies to start with. While I do not find that very surprising, I think it would be worthwhile to zoom in on those recovered zombies and compare relapsers with non-relapsers, because this might provide the authors with the opportunity to distinguish between insolvent and liquid firms. And this is exactly what the literature has been wrestling with, because a zombie firm is actually an insolvent firm, not an illiquid firm, right? So maybe those relapsers are more likely to be insolvent because and these non-relapsers are more likely to have been illiquid. An illiquid firm is different from an insolvent firm in that if you just give an illiquid firm the financial means to invest in productive investment opportunities, it can navigate itself out of dire straits. But with an insolvent firm, no matter how much good money you throw after bad money, nothing happens, right? So maybe this may be a worthwhile comparison to look at in this paper. Last point I would like to make, on the last slide, Ryan alluded to the analysis the authors have regarding the greater persistence of zombies after 2000. And in particular, the authors believe that this is due to the reduced financial pressure. And the way that they arrive at this conclusion is by showing that there's a lack of enhanced performance of these zombies after 2000. So they are concluding that this has to be due to reduced financial pressure or greater accommodation by banks. Now, this story overall goes back to the fact that weakly capitalized banks may engage in evergreening of loans to these distressed firms, which in turn, however, crowds out credit to healthy firms. And this would be consistent with reduced exit rates for zombie firms, higher exit rates for healthy firms, and less entry overall. All three facts in line with what the authors are showing. And this just goes to show the point I made earlier that it's just really, really important to keep these competitive effects in mind. So with that, let me conclude. I believe it's a very interesting paper on an important topic. I would like to reiterate the point that it's really, really hard, despite the fact that I am empathetic to the idea of the authors, to zoom in on the zombies and look at their anatomy in isolation of non-zombies. It's just very hard to understand zombies without considering their effect, the effect that they have on non-zombies. Lastly, a bit of food for thought, focusing on Europe. It's not clear how big of an issue zombie firms are in Europe going forward. This has to do with the enormous efforts that we put towards streamlining supervision in the euro area. And there is already a regulation from the single supervisory mechanism that tighter bank supervision can indeed mitigate zombie lending. That's it from my end. Thank you very much. You're muted, Pierre.
So, okay, thank you for that. I was saying there are many, many questions and remarks. Do you have other, is there other questions from the floor? No. So I just want to add a small one. So I was wondering whether, I mean, you have information about the location of this zombie firm. I mean, within countries, whether they are really, you have like clusters of zombie firms in deprived areas. So I see that Moritz.
Thanks, Pierre. I guess Ryan or Boris are going to address this anyways, because Farzad and Federica brought it up as well. But I would also push a little back on the sectoral trends and on the definitions. It seems indeed that a lot of your zombie firms are concentrated in like mining industries and sort of brown, dirty industries that have invested a lot and potentially depreciate a lot. That's one. And the other, and related to that is like using these other definitions. Farzad had this nice slide, I think, about the what people have done. Do these trends really look similar? How do things look like if we do what Federica suggested, weigh by employment or output instead of looking at zombie shares? So I'm like, I mean, we've discussed this and you've been very helpful with in other ways, and I've looked at the data, but I'm still like skeptical to what extent I should look at, say, let the European economy and conclude that we really have a zombie problem, however defined, even if we and the interpretation, if this has to do with low rates or whatever, is a completely separate issue. But is there an issue in the first place? I'll be pressing you a little harder on that as well, I think, as both panelists did as well. Thank you.
Okay, thank you for these remarks. If there is no other questions, perhaps you can start answering.
Yeah, I was going to let Boris take the hot seat first, and I can fill in afterwards.
Yes, I'm happy to do that. Thanks a lot. Yeah, thanks a lot, Frederica. Thanks a lot, Farzad, for the very interesting discussion. Also, thanks to the additional questions from the floor. So let me just go through the questions and try to provide some answers. So let me maybe first focus on Frederica's comments. Of course, I mean, in the end, the zombie share itself is probably less informative than the weight of the zombies in the economy. In fact, we look at that in the paper. So we compute weighted zombie shares. So we just didn't have that in the slides in the interest of time. And what you see there is that, in fact, the weighted zombie shares are smaller. So if you weight them by assets or by capital or debt, then it's about half of what we have for the unweighted zombie share. However, as we point out in the paper, it's important to bear in mind that our analysis focuses on listed companies, right? So it means we do not cover the universe of non-listed companies. And as Farzad has pointed out, the number of zombies is probably larger amongst the unlisted firms than amongst the listed firms. In which sense one might see our results as representing something as the lower bound. And in fact, when we look at the weighted share of zombie firms amongst the listed small and medium-sized enterprises, which we can look at in our analysis, then we see that the share there is considerably higher. And in this sense, I think the results that we show suggest that also the economic weight of these zombies is probably high, although we cannot precisely measure it for the reason that I mentioned, because we focus on the listed firms in order to be able to go back further in time, in order to be able to take into account a forward-looking measure of profitability in the definition. Then Frederica also raised a couple of questions on our definition of zombie firms, specifically on the role of the Tobin's Q, what role it plays also in the sectoral zombie shares. So there I would just like to highlight also in relation to Moritz's comments that we in fact do a robustness check looking at other zombie definitions in the annex of the paper, and there in fact it turns out that the trend over time of the zombie shares is quite similar across the different definitions that we can look at. So we look at definitions that just focus on profitability and age of the firm. We also look at the subsidized credit definition. We also consider different benchmark for the Tobin's Q, so looking at the national stock market rather than the global sectoral stock market. And there it turns out that by and large the trend development is very similar. Of course, there are differences in the quantitative measure of zombie firms, and this suggests that's important to bear in mind, that I think what our results suggest is that there is an upward trend in the share of zombie firms, and an upward trend also in the weight in the economy. But of course, it's very hard to quantify precisely how many zombie firms there are. So this is obviously clearly a caveat that has to be taken into account. However, the analysis on the anatomy and life cycle that we present seems to suggest that taking into account the forward-looking element in the definition of the zombie firm might get you in a better position to actually identify zombie firms than the other definitions that are out there in the literature. Then there were a couple of further points by Frederica, so whether we should compare with really all the companies, or maybe rather take out the superstar firms. So I mean, I think a natural comparison is to look at the non-zombie firms, and I think obviously if you would take out the superstar firms, for example, then the zombie firms would look a little bit better, but qualitatively, this in my view would not make a big difference. Then there was the point on if looking at the firms, the zombie firms that do not exit the market as we do in the life cycle analysis, if these are not the false zombies. But there I think it's exactly the issue that the zombies, that they do not seem to exit the market. And in this sense, I think this is exactly the question that we want to address. So what's going on with these zombie firms, right? And in addition to that, it's important to also bear in mind that on top of the zombie firms, there's this growing share of recovered zombies, which seem to remain weak and seem to be relapsing with an increasing probability into the zombie status. And in this sense, I'm not sure if I would agree with Frederica's comment that we overestimate the number of zombies, because first of all, overall the trend and also in a way the quantities, they seem to be fairly robust across different definitions. And on top of that, we have to take into account that there's this growing number of recovered zombies, as I mentioned. Then coming to Fazad's comments, so the competitive effects. So this basically harks back to the congestion effect that Ryan mentioned at the beginning. So also there, in fact, we have an analysis of that in an annex of the paper. We put it into an annex because it's not the main focus of this paper. We looked at that in more detail in an earlier paper in our BIS quarterly review article from 2018. And there, in fact, we see that there are significant congestion effects in the sense that the higher share of zombie firms in the sector reduces investment and reduces employment of non-zombie firms. Then on the other comments, so we can certainly consider more granular fixed effects. So we need to probably discuss that and also interaction effects of the zombie shares, and also the question EBIT versus EBITDA. So I think that's a very good point, and we should probably go back and check that. But maybe Ryan has more to say about that later. And then it's probably also a good point to have another element of the analysis zooming in on the recovered zombie firms. So basically distinguishing between the relapsing and non-relapsing ones. Now, quickly turning to the comments from the floor. So first, Pierre. So if we can see where the zombie companies are. So we have a chart in the paper that shows the zombie shares by country. So this is basically the level we can go down to. And that essentially shows that the zombie shares is in fact actually particularly high in Anglo-Saxon countries, and is actually maybe counter expectations lower in continental European countries than, for example, in the US. But what we suggest is that that could also reflect the fact that smaller companies are more likely to list in the stock market in these countries as opposed to European countries, and that might, in this sense, yield higher zombie shares in the Anglo-Saxon countries, and probably also means that the zombie shares in Anglo-Saxon countries might give a more accurate picture, given that there are also a larger number of small firms listed in these countries. And then on Moritz's comments, yeah, I mean, it's certainly right, the sectoral zombie firms, but here we have to take into account that this is only a snapshot of the most recent distribution of zombie firms. Because if you go back in time, we will see that there were then other sectors in earlier periods that were dominating the zombie shares in the country. So there might be scope to maybe have more documentation on that. And then on the other definitions, as I mentioned before, so in the annex of the paper, we actually consider other definitions, and it turns out that at least the trend development of the zombie share over time, that seems to be quite robust across definitions. And also quantitatively, it's not the case that there are huge differences. Of course, differences in the precise number that you would get, but overall the difference is not big. But as I mentioned before, an important contribution of our paper that we suggest is that take into account the forward-looking element in the of profits in the zombie definition. Could probably give a more precise measure. So these are my responses. So let's see if Ryan has maybe has something to add to that, if there's time.
So yeah, I was going to say this. If you're willing for Swiss time, okay. I was going to one point on this sectoral part, and I think it's important and interesting. And so when you look, actually we're trying to write another paper on this if we get enough time from policy work, which is basically if you look back in time, it's not the same sectors that were zombies. It seems to be sectors that are facing, at least some in earlier periods, is sectors that are facing a certain amount of disruption where the zombie firms appear. So what you saw in the 90s was a lot of things in consumer durables, shipping, where there was a competition from East Asia at that time, and you see the zombie share rise there. So what we're saying is that the zombies they come, and that's fine. The question that's interesting for us, or what we found from by looking at them more carefully, is that how long they stay, and that the way that the length that they stay seems to have increased over time, or relative to the non-zombies. And so that's the trend that's kind of interesting, is that market forces are working. They do get smaller. They are under pressure, but that pressure has declined, and that is one of the contributions to this ratcheting up. And so I think it's sort of like this sort of difference, the change. That's kind of what we're more interested, rather is kind of interesting, as well as the level.
Okay, thank you very much. We are 3 minutes ahead of time, but so we have time for another question if there are other questions for the floor. Otherwise, we thank you for this very nice presentation, very nice paper, and we can switch to the next paper, which is about EU fiscal capacity, and Brian is presenting the paper. So Brian, please come in.
Can people hear me?
Yes.
Yeah. Let me share my screen. If you will bear with me, hold on a second. Okay. Can you guys all see the screen?
Yes, you can go full screen. Yeah. Nice, perfect.
So let me, I'd like to sort of preface the presentation by saying a little bit about the co-authorship here, the collaboration, all the names that you see on the screen. I mean, it's often true that we have very idiosyncratic ad hoc reasons to work together, but this is a very self-conscious collaboration that reflects the work that we've done within the University of Amsterdam between disciplines. And in this particular case, of course, the topic is EU fiscal capacities, the sort of political fights that have emerged and rage about the propriety of such capacity, of these kinds of endowments at the EU level. And these are debates that are carried on and thought about by academics in all these different disciplines. And Roel Beetsma, who's in the call and is the lead author of this project, is a practicing economist who looks at the design of fiscal endowments, fiscal capacities in the EU. Somebody who thinks about economic debates about the design issues of fiscal capacities that make sense. Frank van den Broeke, as a policymaker and then also as an economist, a political economist, is interested in those issues. But my training and the other co-authors is really quite different. So, for instance, Aniek de Ruyter looks at this study from the point of view of legal wording. It becomes very important for the experiment that we ended up carrying out. And both Francesco Nicoli and myself have some substantial experience in designing survey experiments in different kinds. And so we knew it was really important for us to work together to know what kinds of questions to ask. We needed to talk to Roel about that, which ones made the most sense, what's going on in the most important debates. Frank, really important for the policy side. Anyway, it's a very, very self-conscious collaboration. So what we're going to do, or what I'm going to do now in the coming 15 minutes, is say something about the principal findings of the study, the sort of the main results of this original survey experiment that we ran and analyzed. And I want to sort of set that up by reminding you very briefly what the backdrop is, right? The backdrop is pretty obvious, that the Eurozone, European countries in general, I think OECD countries more generally still have been hit by a range of shocks. Many of these can be seen as relatively temporary shocks, so the global financial crisis, COVID, a variety of other shocks. And some of these have strong common effects, and particularly problematic are the situations where we see asymmetric effects, and those effects are very negative. And of course, this has fostered some sense that there's a need for the development of more EU-level competence with respect to fiscal capacity or budgetary instruments. And of course, for decades, this has been talked about as part of the sort of remit of the EU. There have been specific calls for the development of these kinds of capacities, certainly since the 1970s, up through and including discussion in current debate in the sort of era of COVID, among them the next generation EU discussions. So this is something very much on the docket, as it were, of policymaker discussion, national government discussion within Europe, within the EMU zone governments. And of course, if you look at the specifics of these different proposals, particularly the recent ones, you see a lot of variation in how general they are, how ambitious they are, what kind of financing, what kinds of conditionality. But it's just worth saying that there's a huge amount of variation in the design of what kind of fiscal capacity makes sense. And the particular initiatives that have gotten most attention are the ones that I've studied in my previous work, so particularly unemployment reinsurance with Frank van den Broeke and others. There's been people who look specifically at the role of investment. And the reason why there's a lot of academic work on that is because that's where it seems like there's been the most discussion, at least until recently, where it's become broader, I think, of these initiatives. It's important to say that in our thinking about these politics, it's an obvious point for me to make, but maybe a little bit less obvious for you all as an economist audience. It's very important to recognize what the import is, or what the role is of public opinion in the development of these EU fiscal capacities. So the premise of our work is that public opinion matters, right? That it matters obviously in democratic polities, in the creation of public policy positions at the national level, then at the EU level. It informs what parties are doing. It informs what governments demand, how they negotiate at the EU level. And it's also important to recognize that even when you don't see sort of an aggregation of interest in formal politics, public opinion always plays a role in a more diffuse way, right? In the background of more elite-led interactions on these politics. So public opinion matters, right? We can talk about how much it matters, but it matters as a premise of this project. And then, of course, there's a literature on how public opinion matters and what public opinions are on EU fiscal capacities. There's an extensive literature that's primarily observational in character, looking at public opinion. And I think more recently, really the last 5 years, there's been literature that's been more experimental in nature, framing experiment work, some conjoint experiment work, including work that I've been a part of in the last few years, looking at unemployment-related EU policies. But there's a really important shortcoming in that literature, and that is that if you look at particularly the experimental studies, they don't give a broad airing to some of the most important fears that policymakers are expressing and that are getting a lot of traction in political fights. So, for instance, fears about the permanence of transfers and how that can lead to systematic redistribution in a system of fiscal capacity building. How there can be real problems of moral hazard, right, where you have transfers that are facilitated, made less costly, and as a result, you have, in a sense, less necessity to actually introduce reforms. Right? It can encourage profligacy, as we write here. Obviously, there's always concerns about national sovereignty. The real point is that there are very substantial design issue concerns that people have, and these play out in the design discussions in policy, and the studies of public opinion have actually not given sufficient airing to exactly those policy dimensions, and that's what inspired us to do this specific study that I'm going to summarize in the rest of my time. The overview is just that the paper that we're presenting now is a paper that presents the main results, the main effect results of a survey experiment that I'll describe in a moment, looking at different kinds of EU budgetary support capacities. And it's important to see that the reason why this is an important kind of way of looking at things is that it involves a very specific kind of experimental approach that allows us to make somewhat stronger inferences in terms of the internal validity of the claims, at least, that is with respect to the data that we're looking at. We're able to make slightly, stronger inferences about, causal inferences about what design characteristics do to the attitudes of respondents in thinking about EU fiscal capacities, right? And in particular, it allows us to make the relatively strong causal inferences about how specific design characteristics of an EU instrument, an EU fiscal instrument, promotes or retards support for some kind of capacity building, right? And the kinds of dimensions that we're really interested in, as I said before, are those that are really awakened by and are, I think, at the center of debates and fears about the design of this kind of EU capacity. So now let me tell you about the survey design. So this is a survey that we carried out in March 2020. We did a pilot in December 2019, beginning of December 2019. But the main waves were carried out in 2020, so in the middle of the COVID crisis. 2,000 respondents in each of 5 countries, right? You see the countries in our sample. So that was Germany, France, Italy, the Netherlands, and Spain. And we selected these countries because we consider them to be important to this debate, but also because they capture important differences in sort of structural and more temporary exposure to shocks and the sort of distributional consequences of these shocks. And also different positions in the EU, the explicit EU debate, right? So recall that this was a period of time when the foreign minister of the Netherlands was in quite vocal media argument with the Italian people and with Italian representatives in politics, right? So we wanted the sample to represent that kind of variation. The sample populations were drawn from the organization that actually carried out the details of the survey, namely Ipsos. These are online panels, and we had quotas for some of the basic demographic characteristics that we wanted to make sure were representative in the sample. So income quintiles, gender, age, occupation at the 1-digit ISCO level and region and so on. The design that matters for the study is partly the observational characteristics. We have a lot of observational questions that are important to the design of the study, but by far the most important and the center of our study that we're presenting here are the experimental components or modules of the study. And it's a nested experiment involving, in fact, 2 experiments. One of them is a framing experiment to try and see what effect, if any, the framing might matter, where the framing might be more focused on temporary shocks, the temporary character of shocks that might put national fiscal policies in trouble and necessitate some kind of activity at the EU level, versus more permanent shocks, so shocks that are about much more long-term labor market problems and adjustment issues. And we wanted to see, does that framing matter, right, as a political matter, but also as a substantive design issue matter. Secondly, we were interested in the specific design characteristics of policy that indeed got at the fears that I was mentioning before, characteristics that of policy that might give more or less attention to issues of moral hazard and budgetary conditionality, for example. And that kind of level of design is much better to try and study using a conjoint experiment that I'll explain in just a moment. First, I want to say something about the framing experiment, and then I'll say in more detail something about the conjoint material. The framing experiment, in both cases, both the temporary frame and the more structural shock frame, start with introducing the respondents to the idea that there are important fiscal policies, right? That governments spend money on military programs, on social assistance, on housing, these kinds of things, and that a big part of their budget involve, big part of their activity involve that kind of spending. And then for the temporary shock frame, it then says, well, sometimes countries can be hit by severe but temporary economic downturn, and this can have all kinds of problems. We mentioned that they have problems for the budgets that put countries in a position where they might have to cut back on some of their programs without mentioning the specific programs. And then we ask the specific question about whether the respondent can give us their opinion about a new European program discussed by member states to address these kinds of difficulties. And then we say, this is very important for the design of this instrument, we say that this program has a particular level of, as it were, generosity or size. So we're talking about a program that will not be larger than 1% of the receiving country's GDP. And then also important for the framing, we then say the purpose of this, of course, is to help governments maintain their policies despite to deal with the economic downturn and stabilize the economic situation. And then what you should understand is that the permanent shock frame is identical, except for what you see on the screen here, the slightly larger print. So instead of talking about temporary economic downturns, it talks about long-lasting economic problems, such as a permanent decline in an important industrial sector. And then after introducing what we want them to express an opinion about, the permanent shock frame then says the budget support would help governments maintain their policies and address these long-lasting problems, right? Those are the kinds of differences that we end up exploring. And to be clear, the question is whether that evokes different standards, different attitudes and support for this kind of a capacity. The conjoint experiment is something that might be familiar to a number of you. It's become a very important tool in survey research, experimental survey research, in a lot of the social sciences. I'm not going to spend much time describing it as a broad idea and where it came from. But understand that here in this particular case, what happens is that after the framing that I just described, we would then ask the respondents we show the respondents, they're confronted with sort of pairs of policy packages, 2 packages at a time, side by side, and each package is described with respect to a variety of characteristics on 6 dimensions. And then when they see these on the screen, they're then asked 2 questions, right? They're first asked, okay, look at these 2 packages. Of these 2 packages, which do you prefer? And importantly, which do you dislike least? Right? So you don't have to necessarily think it's good, but you just have to choose which of these things you find to be most worthy of your embrace, or that you run away from less fast. And then secondly, we ask them to make a judgment about every one of the packages that they see, the 2 packages that are on the screen. And then we repeat this same exercise 3 times so that they make judgments about 6 packages, right? They make a rating of them, but they also choose 3 packages in these 3 pairings, okay? Here are the dimensions. The dimensions are, there are 6 dimensions. The first is a conditionality question about whether there are sort of, in a sense, budget balancing kinds of expectations. There can be none. You say there are no conditions with respect to budgetary policy. Or instead, you could say, you might see that the policy includes the demand that countries reduce their public debt in good economic times, otherwise they will not receive support in bad times. And then we could have a similar kind of series of choices with respect to a second question, which is about whether there should be conditionality on specific ways of spending the money. There can be no restrictions, so people can spend it any way they please, or yes, there are restrictions, there are expectations that the money be spent on education, or on unemployment, or on transport and infrastructure, on protecting the banking system and its depositors, or on healthcare. The third dimension is about the monitoring role of the European Commission. Answers can be no monitoring role, or instead there could be the expectation that the European Commission is supposed to do a lot. a fourth dimension is about whether the countries receive more support than they pay into. It's really about between country redistribution, and there can be no redistribution, or there can be, in a sense, redistribution for all countries in the long run who get into budgetary difficulty. They can draw more out than they pay in, or there can be skewed redistribution from rich to poor countries, right, as an option. And then the last two options are pretty straightforward. One is, what is the long-term tax impact? There can be none. There can be a flat tax of 0.5%, or there can be a more progressive tax of 1%. And then finally, are there extra penalties, yes or no, for non-compliance? So these are the specific characteristics we look at. This is the kind of screen that the respondents actually see. It's important to say there's a lot of literature about whether this overloads respondents. We do a lot of pre-testing to make sure that that's not the case. But this is the way it looks on the screen to a respondent. Okay, the key here is to recognize that this is a large sample that includes randomized implementation of the treatment, and this allows us to make strong judgments about what underlies the choice that people make, the choosing of a package, yes or no, right, our first dependent variable, or the support that they express. And because the support is given to all packages, regardless of the design, you can make some judgments of, what is the overall level of support for this kind of assistance. And if you look at the histograms, you can see that in all cases, the countries in our sample, there's more support than there is opposition, but of course, in most places, the neutrals are more substantial. Okay, we could talk about that later, but here's what I want to emphasize. We ran models that set as our dependent variable either the choice or this support measure. And we want to try and look particularly at the role of these particular dimensions. So the specific characteristics of the different packages, whether those increase or decrease or have no effect on the likelihood of supporting some kind of EU fiscal capacity. And we do that by including a range of demographic controls, country dummies, pairing dummies, framing dummies. But the key is that because this is an experimental design, those things don't turn out to matter very much in the results. We do a whole bunch of sensitivity and robustness tests that are of significance. I'll get to those in just a moment, but first let me run you through the most important basic findings. The basic story is that you see that people want budgetary conditions, regardless of which of these dependent variables you take in the study. People tend to want some budgetary sort of spending guidelines, and particularly for social spending, they're interested in that. They're quite opposed to bank spending, or spending to protect banks and depositors. There's quite substantial support for an active EU Commission role in monitoring and guidelines that you can see here, and support for redistribution of some form, between country redistribution, slightly more for rich to poor redistribution, but in general some kind of redistribution. As you can expect, there's a real opposition to a long-term taxation burden. But the difference between no taxes and a progressive sort of tax financing system is, I think, is very modest. And you can see that the framing effects are already in this figure very small, right? And in this particular case, it's basically saying that there's only slightly less support for these kinds of programs when we're looking at a permanent shock compared to a temporary shock. And that turns out also to play out when you start looking at these marginal component effects, looking at the different framing effects, where you can basically see that regardless of the framing, you get that same pattern that I showed you on average. And the question is whether that's a design issue, right? Or if instead people are making a substantive judgment that expresses either not knowing much about this or not caring very much about these kinds of differences. The basic punchline in terms of what happens with the country distinction is that you do see some distinctions, right? And some of them are comport with what you would expect, right? So for instance, Italy is the only country that does not support this budgetary conditionality, and the Germans and the Dutch are the strongest in supporting it. And then if you look at the role of the Commission, all the countries in the sample support some kind of role, either a very activist one or one that includes at least monitoring. And then with respect to these other, the last three dimensions, the most important thing here to see here is that when it comes to redistribution, it's only the Netherlands that is opposed to it. And when it comes to termination and penalties, it's opposed by Italy, supported by the Dutch. So you can sort of see this sort of classic distinction between countries that you might expect from debates about these issues. The last thing I want to, and I know I need to stop, right? Yeah. So let me finish by saying that the bottom line, punchline is what you have in the way of expectations for support for these kinds of programs, and it's these last two that matter, where you can actually see support above 50% support in various different sort of manifestations for a fiscal capacity that includes these ingredients of budgetary conditions, healthcare spending, monitoring, poor country redistribution, and progressive taxation. And that support kind of falls apart, or it becomes much softer when you start to introduce characteristics like a flat tax. And that's true also when you look at the country stories, where you see the flat tax option does not sort of carry majorities in two of the sample countries, but that more progressive package survives the sort of majority sort of whiff of all these different polities. There's a lot to say about the sensitivity and robustness test, which I ran out of time to do, so I can take that on in a moment. But the bottom line punchline is that we see support for these programs, and we see support for a very conditional kind of assistance that involves, for instance, budgetary disciplining, conditionality, social spending guidelines, and the like. Thanks.
Okay, thank you very much, Edouard. The floor is yours.
Yep, I'm gonna share my screen right now. Let me make it bigger. I see a black screen. Oh yeah, here it comes. You can see it, right? And you can hear me.
Yes, perfect.
Okay, great. Well, thank you very much for the organizers for the opportunity to discuss this paper. It was a very interesting paper to read. I liked it a lot. And I also liked Brian's presentation very much, because I think it put into perspective something that were not so much emphasized in the paper. So it was great as well. Just a brief summary of the result, and then a few general and speculative comments. So the idea of the paper is to elicit directly preferences of EU citizens for the notion of a central fiscal capacity. So Brian did a good job at describing the experimental design. So I'm not going to go into too much details on that, but basically you have these two. You have two. Every choice of package. It took me. I'm saying this because it took me some time to really understand what the choices that respondents were faced to. So people need to choose 3 times between a pair of packages, and they are presented as one frame. Okay, and in these 2 packages, so the frame is what, the shock is permanent or transitory, and every time you have 2 packages that you need to compare. There are 6 attributes per package, and 3 to 6 possible contents per attribute. Okay, and because the attributes are randomly assigned to packages when it's sent to respondents, you can causally infer the marginal impact of one particular attribute on the support for that feature of the package. Okay, so that's the idea of how things are run. Now, we've seen the results. So I'm going to be fairly quick on that too. Some of them are not very surprising. Some are more. So there is support overall. So I'm going to be presenting the baseline results, not going into the details, and then discuss some cross-country differences later on. But there is overall broad support for budgetary conditions, meaning, so in the context of the survey, that means you need, should the countries reduce their debt in good time? Is that the condition for providing support? And the answer is roughly yes, which perhaps is not surprising given the question, the way the question was asked. Now, the area of spending, I may return to that later if I have time, but there are two, so the questions were asked in March of 2020. So it's perhaps unsurprising that healthcare has an important support in the packages. And education also has an important support, especially for the framing that pushes people to think that it's a permanent shock. So long-run growth is involved. People support the control and eventually possibly the recommendation by the European Commission in implementing the common fiscal policy. People are open to some long-run redistribution across countries, and that was surprising to me. Taxation, I'm going to skip that because I found it quite hard to interpret the question about taxation. It seems to be saying that people don't like being taxed, which I think, you know, we could have guessed. And surprisingly as well, people are against punishment for non-compliance. And I thought that was also unexpected. I may return to that later as well. The results are generally robust across a variety of checks. So the framing doesn't seem to matter too much for the results, except for the spending on education. They are roughly robust across countries, but there is still a north versus south divide in some dimensions, to which I will return. And once you take into account these differences in country, the additional effect of the framing is very limited. Okay, so from those answers, you can kind of cook up the politically optimal package in the sense that it's the package that's going to be gathering the maximum amount of support from EU citizens from a variety of countries. So that package has some budgetary conditions. So, you know, countries should reduce their debt in good time. It has mandatory healthcare spending. Again, the questions were sent out in March 2020. The European Commission should monitor spending and make recommendations. It could involve some redistribution across countries in the long run. Again, so but taxation should not increase. So again, that I find it a bit difficult to interpret. And there shouldn't be any punishment. So I think it's a very interesting, very original approach to the question, to a very old question that many, you know, all of us have tried to answer in various ways, at least macroeconomists. There are two traditional approaches. One is from macro theory, which is to say, you know, let's try to understand under what conditions it is efficient to have this central fiscal capacity. And you know, this literature uses typically multi-country DSG models with sticky prices. And then what my interpretation of the literature is that it pushes towards, at least in times of liquidity trap, it pushes towards some centralization because aggregate demand is too low in a liquidity trap, and there are extra benefits from cooperation that you do not have when monetary policy is effective. So that's one of the lessons of the Hetting and Mueller paper cited here. But that's macro theory. Macro theory is not really concerned with political implementation typically. there has been many policy proposals to reform the European institutions and the fiscal package of the EU, and these proposals are much more concerned about the implementation and the political feasibility of alternative arrangements. So here the paper shares the same political economy focus, but with an attempt at directly inferring preferences of households to make consensus. Okay, so it's similar in spirits as surveys on the desirability of alternative fiscal policy. So what Stancheva has been doing in the US, for example, and there are other surveys, for example, of member of parliaments to see, to what extent you can gather support.
Edouard, you have 1 minute.
1 minute left, so I'm gonna skip the question that I had about the context and focus on my most important question then. The paper documents interesting cross-country differences in desired level of budgetary condition, control, long-run redistribution, and penalties also. And I was wondering to what extent that could be related to the studies that document differences in level of trust across countries. So here I'm going to cite a paper by Pierre, who can stop me if I misrepresent his thinking because he's chairing the session. The divide that we see in the study has Netherlands that stands out in the survey as being more conservative. And so my question is, the Dutch are wary of more fiscal integration. This is what is coming out of the survey. And it's also a country where there is a high level of trust. And we know from that paper that high trust is supportive of potentially a larger welfare state, unless there is a sufficient number of uncivic people that would threaten, that would benefit from the system, that would take advantage of the civic people. So is it that what the Dutch are fearing? And you could reverse the question, Italians see themselves as not very trustworthy or as a more corrupt country and so on. This is what also comes out of the World Value Survey. Is it that they want to take advantage of the Dutch, and this is why they don't want conditionality? So I wonder if there was a connection to make here. And I had also a quick question about non-response. There was no information in the paper about how you deal with non-response. So we only have information about the respondents, but if non-response is correlated with is correlated with something that is unobservable, then that may, preference for populism, just to name one, that may bias the answer. But I'll stop here. Thank you.
Thank you very much, Edouard, for these many remarks and questions. So, Moritz, it's your turn.
Okay, thank you very much. Thank you very much for the opportunity to discuss this paper. And it was a pleasure actually to listen to Edouard's discussion. Maybe he should have gone on. He had a lot of very excellent comments, and also Brian's presentation was really outstanding. I think very, very clear. So let me now try to do my very best to also add something to the discussion. But for this, I'm going to ask you to close your seatbelts, and I'm going to lift off and take a higher flight height to look at things. Okay, so I think the paper asks really a key, if not the key question for policymakers. What kind of EU budgetary assistance arrangement, if any, do citizens from different European countries prefer? So if this would be an easy question, then I would switch immediately to policymaking. Okay, and then I just go there, make suggestions, and get elected, and everybody likes me. So apparently, this is a pretty tough question to be answered. So what I like very much is now the approach that the authors take, namely to say, let's just ask people what they like. Okay, so let's conduct a survey to learn about EU citizens' attitudes towards different policy proposals. Okay, and now the idea is, I understand it, is to say, let's try to learn something about policy proposals are typically like very complicated objects. They have a lot of dimensions, financing, conditionality. We just heard about all these different dimensions. And oftentimes the discussion is a little bit about like, oh, how should we like bundle, or like how should we design our proposal such that people are going to be in favor of it. So now the idea is we are going to vary a little bit here and vary a little bit there, and just see how is going to how is the support going to change for this policy proposal. So it's like really like asking a question: do you prefer reform package X over Y if there's more Z in the program? And how much do you like program X? So one thing that I think Brian didn't touch upon, but what was very surprising to me, and this is now like maybe a combination of like a result and an assumption at the same time. So what they found is that there's little support for that packaging matters. Like it does not change my valuation or how much I like the package if there's conditionality depending on what we do, like if we do additional taxation. I would have expected, like, if we tax, I probably want to have some rules on the budget, or that these things are somehow related, and that we have some trade-offs here to face. If we want to do a little bit more of this, then probably we have to also go a little bit more in the other direction. But what they find is, as soon as they introduce interaction effects in their regression, they say they find very little support for packaging, but that's really modular dimensions. One reason for this could be that how the survey is designed, and maybe this is on purpose, that these are really very orthogonal dimensions. So what is like my interpretation to what they do, or how would I interpret or remember what they have done? So I was just teaching like price indices, and then I realized maybe this is like reasonably similar. So what they actually try to do is not a hedonic price index, but a hedonic support index. So we just want to figure out how much do consumers value certain dimensions of a product, so that if next period we're going to observe the product with different dimensions, then we can do quality adjustment. Okay, so in the end, they want to learn something about the different dimensions of quality of a reform package, and then this allows us to somehow price or like give a support number to a package, or also learn how to vary different dimensions of the package to learn something about the quality. So now, as always, if you do such an index, there are potential concerns. The authors write, we have completely formulated assistance packages. So, well, you can always think about, well, there's maybe additional dimensions that we could add to the package. And like one dimension I was like constantly concerned about, and I think that also came up in Brian's discussion about, like, there are fears of policymakers. So it seemed to be very much a survey about the fears of policymakers, but maybe there were some, like, and then the different dimensions were asked about, but maybe there's also fears of the electorate, that people are concerned about, oh, policymakers say this is our reform, then we are going to get into a crisis, and then they start renegotiating again. So, like, one of my key concern, if there's always like these big plans and these great reforms, is like, oh, and maybe this particularly at the EU level, there's discretion, timing, consistency, and maybe people are also very concerned about, even if we now say it's conditionality, that this conditionality is actually not binding, but it's just something that's written on the paper to make me vote for this program. Then I talked already about this surprising absence of policy trade-offs. And then one thing I was like really wondering about, or like where I tried to put myself into the shoes of someone who was supposed to answer the survey. There are two policy packages, and now you only vary the taxing dimension. Like now, no taxes relative to tax the top 1%. Which one do you like more? I would somehow say, no, something is going on, is wrong here. Like there seems to be money on the table. I can do the one where I don't have to tax. There's another one where I have to tax. Like one of these packages is not consistent, not feasible. How should I think about this? And like, I'm happy that I was not part of the survey. I might have quitted in that moment of time, because I say like, that doesn't make sense. We compare apples to oranges. How should I think about this trade-off? Okay, so then, and that was like, I think what Eduard was discussing there about the theory view and the implementation view, that like is probably much deeper than what I have to say here. But I want to like point in one direction. I think for this kind of surveys, what might be an interesting thing to think about is just what do people actually think Europe can do over what individual countries can do? Like, what would we need Europe for, what not like the Netherlands, Spain, or Germany can do on their own? And then there are like things that just came to my simple mind were like situations where there's no possibility for self-insurance, or where self-insurance is just more costly than mutual insurance within Europe. So one, like liquidity, like if countries somehow had some constraint where they cannot raise debt, then it might be a situation where mutual insurance might be a good thing to offer. But obviously, there are then trade-offs between insurance and incentives, that as soon as we have these programs, moral hazard kicks in. So even if we do something at the European level, then and that's something that's very much discussed in the paper. But there could also be other things, coming back to my concern about discretion or timing consistency. There might be limited commitment. Like at some point, I would be the one who has to pay into the system, although I was a country who always thought I'm going to receive, and now do I still keep to my promises that I gave in the past, or do I then go back to the European Council and say, let's renegotiate now? I somehow changed my mind. So is that like an important concern about any European initiative?
Moritz, you're running out of time too.
Okay, so I'm more or less done. So I just want to make this one point. So maybe it would be an interesting like project for the future to think about asking European citizens also, what do you think the EU can do, what EU governments cannot do? Or should we think about all these EU programs, not very in terms of economic efficiency, but more about investing in a European identity to serving like a bigger goal, rather than just thinking about what simple-minded macroeconomists might think about? I had some suggestions. Overall, I want to conclude this is a super interesting, thought-provoking paper that measures commonly held views on political attitudes. I think it provides a lot of guidance for policy making, and maybe we just have to try to learn a little bit more about what European citizens actually think about, where Europe can do more than just each single country can do alone. And I think that's something that Eduard also pointed out, these two strands of literature, one thinking about implementation, the other one thinking about efficiency. Maybe this also tells us that we need to rethink optimal policy if they do not coincide with political support, or political support has to be a constraint in our optimal policy design. Thank you very much.
Okay, thank you, Moritz. Thank you, Eduard, for these passionate discussions. If there is no other question, we can go to the answers, because we are running out of time. So no question from the floor, apparently. So, Ryan, do you want to start answering?
Sure. Yeah. So let me thank both Eduard and Moritz for really terrific comments. And I think I have less than 5 minutes, and I want to make sure that if Roel wants to add something, he does it. So I'll take 3 minutes. Eduard, you mentioned a number of really important issues, like what role does trust play in these politics and in the differences that you see between the countries. And we haven't used this paper to try and explore that specific question, but that hypothesis that you offered is one of the ones on our list, and we can explore that. We can do that because there's there's a general trust question that we have as an observational question that allows us to look at whether that can, in a sense, explain away the country differences. But as a general matter, I think that your intuition is exactly right. I mean, that is the way a lot of social insurance works, and support for social contributions is that if you have a sense of intra-group trust, then you're supportive of that intra-group assistance and contributions. But if you don't trust people to use the money well, then you see a very significant dropping in that support, and that's a big part of the way the Dutch look at the EU, right? For better or worse. Non-response is definitely an issue in theory, but this is based on the Ipsos panel, right? So we don't have the information that we want to answer your question. So we don't have non-response in the sense that we don't measure exactly who looked at, was asked to look at, and then decided not to answer the question in the panel the way Ipsos works. And Ipsos would not give us that kind of information. This is one of the drawbacks of Ipsos. They don't want you to see or talk to your panel, to their panel. So we don't know the answer to this question. And your hypothesis is a good one, that there can be all kinds of biases that go into who ultimately decides to do this work. That's the main reason, by the way, why the quotas become important. It's a way of forcing some level of control on, in a sense, non-observable non-response rates, if you know what I mean. So if you make sure that you have younger people who are doing, people who are unemployed, and so on. And then to these points that Maurits.
Just if people are withdrawn, if people stop answering the survey, they leave or they are withdrawn from the representative sample?
Every panel. So for instance, the Dutch panel, they have a panel of people who are part of an online panel who get paid for every survey that they do, and they're in the system. And what happens is that they put out every day, oh yeah, here's some surveys, takes roughly 40 minutes. Can you fill it out? And you can choose to do it or not. And we and their panel in the Netherlands includes something like 20,000 people, 30,000 people, and you want to try and fill the quotas for the population representation, and that's becomes the only way to have a check indirectly on making sure that you're getting a reasonable sample. That's why sampling does matter in these panels, because if you just leave it to the young 25-year-old guy who can do a survey every 10 minutes, then you're not gonna get a good panel. Anyway, so let me say at least a couple things about these pretty fascinating points that Maurits made. I mean, you mentioned a variety of important sort of drawbacks in the way we actually can do this kind of a study. We are the ones who set these characteristics, and of course there are many others, an infinite number of characteristics that are worth looking at. And I think you're right about questions in particular that would get at the kind of voter concern or skeptical voter concern about the trustworthiness of elites or of the EU, timing consistency issues. You can put it that way, but it's really about distrust that people will do what they say they're going to do, and that institutions will function or rules will be imposed in a consistent way. And it would be good if we had studies that looked into those kinds of dimensions as well. So I mean, it's just for further research. I know that that's a sad thing to say, but we don't have any leverage to do much with that kind of an observation. And the last thing I want to say is that about this tax feasibility issue, that's something that in the virtue of the conjoint work is that you can do that in the post hoc analysis, right? So we're not interested in the packages where people say, I don't want any taxes, but I want to have all these other things, right? That's why most of the work is focusing on these mean marginal effects, where you say, okay, what is the level of support, ceteris paribus, for the packages that have taxes? And that's why I showed you in the presentation, and also that we focus on in the paper, the packages where you have either flat tax or you have a progressive tax. Those are the ones that become meaningful. From a sampling point of view, you want to include even the nonsensical categories to try and get a full randomization of the kinds of responses that you get. So it's an advantage actually that you include this sort of non-feasible option. There's a lot more to say, so I just want to say thank you for all those really great suggestions and comments, and we'll do our best to take them into account in our.
Can I add a few words on a few things? Well, first of all, thanks a lot for the great discussions on the taxation. you see what we can, with this experiment, we can see what is the effect if you move from not having to pay for the program to having to pay for the program. And so it's not that we take that we take the situation of a free program seriously, but we can see what is the effect of having to pay for it. Now, the second thing I want to say is about, we see that healthcare, mandatory healthcare spending has a big effect. Now, you think this is due to Corona, but actually, as Brian was mentioning, we did a pilot on the Dutch, on Dutch respondents before Corona, end of 2019. We saw the same, almost, I mean, the confidence interval was wider because there were fewer respondents, but we saw again that there was a huge preference for, mandatory healthcare spending. So that's, then finally, my final point is kind of a more general point, and that is we are measuring preferences of the respondents, of the populations, which is not the same as politicians. And we are, in a way, we should think of this as a pre-political environment. So asking people before politicians are discussing these issues and seeking the edges of the, where the polarization is. And so we give the chance to people to express, to think about the issue and to express their true preferences before the politicians, influence them. Thank you.
Okay, there is another question by Tommaso.
Yes, thank you. So very quickly, so mine is a general point on this. So what is not yet clear to me is whether surveyed people were actually exposed in a way to the idea that any sort of EU fiscal capacity mechanism that was sort of proposed to them would directly or indirectly generate the flow of permanent transfers from Northern European to Southern European countries in a way, right? So in a way, the economics of that. And so what can you say about this?
Let me say, well, the short answer is that we can't say a lot, except that one of the dimensions includes this between country redistribution, the wording of which, for one of the possible features on this dimension, the wording of which said, yes, there will be there will be a transfer from rich to poor countries. Poor countries can draw more than they put in, and poor countries will actually be receiving transfers from the rich. That was actually that third option. But it does not mention, I mean, you mentioned something that's really important, right? So you said transfers from north to south, or from very particular named countries. And I actually think that if you were to do the framing, testing that, and we know this from other studies, as soon as you start using proper nouns, it really it sparks and cues different responses. So if you say, what do you think about the Dutch subsidizing the Spaniards, for instance, then you might get a stronger response. I don't think it's going to be strongly biased compared to what we actually pick up in that wording, but we don't know the answer to that question. That's something that we will need to test in other studies if we can get the money to do that. So it's a fascinating issue, and you're right to ask that question.
Okay, Raoul, you have 1 minute to add something if you want. No, it's fine.
Me?
Okay. Yeah.
I can add something or not?
Yeah, 1 minute.
I just want the one thing I want to add is that as a general matter, the last point that Roel mentioned, the pilot compared to the sort of March 2020 results revealed something that to us was really surprising, which is you see virtually no change in the overall level of support for these different kinds of packages. You see very slight shifts, but basically it's a story of consistency. Indeed, you see an uptick in support for health as a spending condition. and you see a downtick in certain other kinds of conditionality, but it's basically the same pattern that we presented, to our surprise. So this is not a story where COVID has created this sort of embrace of a stronger European fiscal capacity. We have good reason to believe that what we report in March 2020 applies more generally.
Okay, thank you very much to all of you. It's time for a short break, 20-minute break. And so we meet for the last paper, the last session in 20 minutes. Madzo, you want to start sharing your slides? So we'll be just on time.
Yeah, for sure. Thank you very much.
Okay, perfect.
Okay, can you see my slides?
Yes. So I think we can, yeah, let's start. So we are very happy to listen to you, Tommaso, about speaking about voting behavior during the lockdown. So the floor is yours.
Okay, so thank you very much for the invitation. We are very happy to be here presenting our paper. So this is a joint work with Gabriel Lumot from ETH Zurich, which is here in the panel as well. So let me start with the motivating evidence. So the introduction of lockdown and in general restrictive measure is one of the most common and powerful way of fighting the recent COVID-19 pandemic. One important debate is whether this type of restrictive policies, the lockdown policies, may affect elections and the electoral outcome, and eventually in which direction this effect may go. In these slides, you can see several examples of newspaper articles discussing the relation between lockdown and elections. For instance, you can see a newspaper article from The Guardian discussing the situation in the US, and in particular arguing whether lockdown may have helped Donald Trump in outperforming the polls in the 2020 presidential elections. You can also see an article discussing about Germany and another one about France, discussing whether next year presidential elections will be somehow affected by the lockdown that President Macron implemented. So in general, there is a large debate on whether lockdown may affect elections, and this is pretty important in many respects. One of these is clearly that this may allow us to understand who will be in charge of managing the post-crisis equilibrium in terms of political, in terms of decision makers. However, this relation is pretty unclear ex ante because the effects of lockdown are very complex. On the one hand, lockdown has clear positive health effects, because this is for sure a very powerful tool to fight the pandemic. On the other hand, these types of restrictions may have even large negative economic effects. Therefore, this issue is primarily an empirical one, and this is what we are doing in our paper. So our paper aims to study the causal effect of lockdown on voting behavior and electoral outcomes. Importantly, differently from the recent studies on this that mostly focuses on survey evidence, we are using real electoral data. In particular, we study the case study of France, that, as all the other European countries, has been highly affected by the pandemic of COVID-19. The country implemented a general lockdown in March, and then after the pandemic peak, the government decided to relax these measures, and in particular, implementing a differential lockdown because the health situation in the country was quite heterogeneous. One part of the country was subject to an hard lockdown, the red area, and the other part of the country went subject to a soft lockdown where restrictions were much weaker. This differential lockdown creates an exogenous spatial variation in the severity of lockdown measures. And this is what we are studying in order to identify a causal effect of the lockdown policy. Moreover, France was one of the few countries in Europe to host elections during the first wave of the pandemic. In particular, local elections took place in the spring of 2020. And this allows us to measure electoral outcome and voting behaviors of French voters just after the end of the lockdown policy. Therefore, in this paper, what we are studying, what we are estimating is a spatial regression discontinuity design, in which we are comparing municipalities that are very close to the lockdown border and that are located in the red or in the green area, and therefore they're similar, but they are subject to very different lockdown policies. So this is the outline of the presentation. I will discuss the institutional background and the data. Then I will discuss the empirical strategy. And finally, I will show the results and the main mechanisms. So as already mentioned, France was severely affected by the first wave of the pandemic. For instance, by October 30, 2020, the country had more than 1,220,000 confirmed COVID-19 cases. So as all the other European countries, France introduced a general lockdown at the beginning of March, in mid-March, in particular on March 17th. And this was a set of restrictive measures that, for instance, limit the movement of individuals, and most of public establishments have been closed. Then, after the reachment of the pandemic peak that you can see here in this figure has been reached on April, here you can see the development of the pandemic in France in the spring of 2020, the government decided to lift these restrictive measures. But the health situation was not uniform in the country. In particular, the northeastern part of France was still highly affected by the pandemic. Therefore, the government decided to relax in a non-uniform way the lockdown. The country has been divided into areas, a red one subject to a hard lockdown and a green one subject to a soft lockdown. Here you can see the map of France with the border that divides the country between the red area and the green area. In the red area, mostly the restrictions remain similar as the previous situation with the general lockdown. While in the green area, the restrictions became much weaker. For instance, movement were allowed again, individuals were allowed to move again within 100 kilometers from their residency, and economic activity in general restarted. So this is the spatial exogenous variation that we are exploiting in this paper to estimate the causal effect of lockdown. On the other hand, France was one of the few countries that host elections during the first wave of the pandemic. In particular, local elections took place in the spring of this year. After a long debate indeed between mayors, political parties, and the government, the president decided to host first round of local elections regularly, and they took place indeed on March 15th. These elections are indeed important because they renew the municipal council and they elect the new mayors. Nevertheless, just 2 days after the first round, the general lockdown was implemented, and this impeded the conduct of the second round regularly, as it was in origin schedule on March 22nd. Therefore, the second round has been postponed up to the end of the restrictions, and it took place at the end, ultimately on June 28th. So with first and second round in these two specific dates, we can measure electoral outcomes and voting behavior just before in the first round and just after second round the lockdown implementation. Here you can see our timeline with the two elections, the two rounds, as well as the important moments for the lockdown implementation. So in this paper, we are exploiting these two key variations, the spatial variation induced by the differential lockdown and this time variation induced by these two electoral rounds among French municipalities. Okay, so we, in terms of data, we mostly focus, we only focus on municipalities that, of course, host a runoff, because just for those we can measure electoral outcomes before and after the lockdown. And we focus on municipalities with more than 1,000 inhabitants because the electoral system changes at that specific population threshold. Then we collect a large set of information in order to do our analysis. We have election data at the polling station level. This is the level of aggregation we are relying on in this paper. The main outcomes are incumbent vote share and voter turnout. Then we have information on lockdown and health outcomes. And finally, we have a large set of covariates that describe demographic, economic, and political municipal information. So in terms of estimation strategy, as I mentioned, we are estimating a spatial regression discontinuity design. The forcing variable is clearly the distance between each municipality and the lockdown border. And then we consider as a treatment group municipalities in the red area subject to the hard lockdown, and as control group those in the green area subject to the soft lockdown. Therefore, in this exercise, we're interested in the treatment effect on the outcome as we get closer and closer to the lockdown border. Importantly, we have two types of dependent variables. First, we study the effect of the lockdown only on second round outcomes. So we only focus on the elections that took place at the end of June. Then, as a second analysis, we focus on the difference between the second and the first round outcomes. This second approach has the key advantage, of course, of keeping fixed all the municipal characteristics. Let me mention, nevertheless, that the results with the two approaches are pretty similar, and this is, of course, reassuring. We have three alternative empirical strategies in this paper. So the baseline is a non-parametric RDD following using the optimal bandwidth according to Calonico. This is the standard local analysis in which we only focus on municipalities very close to the lockdown border. Then we estimate other two alternative strategies with the goal of having a more global approach. Therefore, we have a much larger set of municipalities. First, we estimated the NRD away from the threshold methodology following Angrist and Rakkonen, in which we basically estimate a parametric RDD and we check for the validity of the conditional independency assumption. And then we focus on the universe of French municipalities and we estimate a coarse exact matching following Blackwell. So before going to the main results, let me briefly discuss the validity test that we conduct. So identification in an RDD setting relies on two key assumptions. First, absence of selective sorting, and this is pretty the selective sorting is pretty unlikely in general in spatial RDD, as borders are very stable over time. This is even more unlikely in our case, as the very sudden and unpredictable spread of the virus, and of course the measure implemented, makes very unlikely that voters and municipalities could anticipate this and could react strategically to that. Therefore, this is unlikely to be an issue in our setting. What instead we check is the continuity assumption, studying whether all underlying variables but the treatment are continuous at the border. To check for this, we conducted several tests. First, we look at local diffusion of the virus around the threshold, around the border. This is very important because if we find that the border is the local diffusion of the virus is jumping at the border, this may clearly affect the interpretation of the May results, because the May results may clearly be due to the fact that in the red area there are much more more people are actually infected by the virus. Therefore, in order to check for that, we conducted two tests. First, we look at excess mortality at the municipal level, and we study whether excess mortality is continuous or it is discontinuous at the border. Let me show you this test, which we think is very important. Sorry, I don't know why Okay, I can describe that. What we find here is that the local diffusion of the virus is indeed continuous at the border, suggesting that there is no difference in terms of infection of the COVID if we take municipalities that are very close to the lockdown border. Of course, if you look globally, the two areas, red and green, they are pretty different in terms of internal diffusion of the virus. The red area is much more affected. But if you go very local, you don't see a large difference. And this is important for us because this suggests that we can interpret the treatment mostly as the effect of the policy. This is also due to the fact that the border has been decided in order to retrace regional borders. Is not the government didn't find study exactly the position of the border looking at the local health situation. So in order to corroborate this, we also look at COVID-19 cases in departments, and we also exclude here that there is a jump in the level of the diffusion of the virus. Then we conduct the standard balance check, and we show that a large set of economic, social, and political characteristics are indeed continuous at the border. Let me mention here that we also show that first round results are indeed continuous at the border. This means that these two groups of municipalities behaved very similarly before the introduction of the lockdown in electoral terms. So this means that before the policy, they were quite similar in terms of political preferences. And finally, we also show that police stations are located similarly within municipalities along the two around the border. Otherwise, this may have represented a bias in our analysis. Okay, so let me now move to the main results of the analysis. So here you can see the main table of the paper summarizing the main findings. Let me start discussing the first two columns in which we show the baseline, so the non-parametric RDD analysis. In the first column, we have the analysis only looking at the second round results. In the second column, we have results using and looking at the first diff. Let's start from panel A, in which we look at incumbents' vote share. So as you can see in the red area, the vote share of the incumbent is significantly higher than in the green area. The effect is precisely estimated, and it is large in terms of magnitude compared to the dependent variable average mean that you can see in the bottom part of the panel. Then in panel B, we study the effect on voter turnout. And also in this case, we see a positive and significant effect. So these are the main results of the paper. This is one of the first two columns. And this suggests that municipalities in the red area tend to vote more for the incumbent, and they have a higher level of voter turnout compared to similar municipalities in the green area that have been subject to a much weaker lockdown restrictions. We confirm these results in the other columns of this table, in which we show the results used with the RDDA and the matching approach. Here you can see that these results are confirmed, but they are a bit weaker. Indeed, here we are having a more global approach, and this suggests that these results seems to be quite strong close to the border, and they get a bit weaker as we get farther away. But this is pretty reasonable. Indeed, we may be picking municipalities that are less comparable if we increase the bandwidth, while if we are very close, we are considering very similar municipalities. So what these findings show is that lockdown has a significant effect on voting behavior. These effects are indeed in line with the rally around the flag hypothesis. So the fact that after a disaster, voters tend to lean toward the local incumbent. In this case, French voters seems to lean toward their mayor in the red area. And there are many possible explanations for that. I will discuss them in a minute in the mechanism slide. Let me also remind that we find that these effects are stronger very close to the border, and they seem to be a bit weaker as we get farther away. Okay, so in the last few minutes, let me briefly discuss the main mechanisms of this analysis. So we mostly focus on the effect on incumbent vote share. And what we do here is we basically looked at the literature on natural disasters and pandemic, and we consider the three most plausible mechanisms in our setting. And we're trying to test them and provide a discussion and a test for them. First, one mechanism that it is usually important in this case is the presence of emergency management. This is, for instance, very important after earthquakes or big natural disasters, in which usually large financial flows or intergovernmental transfers are actually arrived in municipalities that are hit by the disaster. This may ultimately increase the popularity of the politicians that are there. This is not the case in our setting, because the policy tools at disposal of the mayors in the two areas were indeed similar. And this means that we don't have, this channel is pretty unlikely in this case. Second, another typical channel in these situations is the media visibility, as politicians that are ruling and that are in charge in these affected areas tend to get very high media visibility, and this may ultimately benefit them at the polls. We check for that, and we basically created a new data set on media exposure of French mayors. We apply text analysis techniques on the portal Factiva, and we measure for every municipalities, but for every mayor, how many times this mayor is mentioned in the French media. And then we estimated our main model, checking whether the media visibility is continuous or not at the threshold. What we find is indeed that this is continuous. So there is no evidence here of this channel. The exposure of red mayors and green mayors, namely mayors in the red area and those in the green area, seems to be continuous. Therefore, even this channel is very unlikely here. Finally, what is most plausible, also according to the recent literature on COVID, is actually that this is due to a behavioral reaction of voters. And there are at least three possible interpretations here. First, there may be emotional mechanisms, such as fear and gratitude. Voters may feel more scared in the red area, as well as more aware of the health crisis, and therefore they may lean toward the incumbent mayor. On the other, secondly, if voters are risk averse, they may value more to vote for a better known candidate, such as the incumbent, and they value less to give their vote for a lesser known candidate, such as the challenger. And this may again benefit the incumbent. And finally, it is also possible that voters are grateful to their mayor for this policy, because they are actually happy to be, the perception of safety is actually higher in the red area, and therefore they may be grateful to the mayor for that. Well, this may be related to some sort of misattribution of the policy, because clearly the policy was decided at the central level by the French government. So the mayors are just implementing that. So if voters are misattributing the policy, maybe they are more likely to reward the incumbent. So in the last minute that I have, let me briefly deepen this last point. In the paper, we have some analysis on that. So we want to basically study how voters attribute the lockdown policies. These are indeed decided always at the central level, and we want to understand whether they attribute them correctly or not. And what we find is indeed that they are misattributing the policies at the administrative level where these are implemented. So we conducted two tests. First, we look at national lockdown. And we show that after a national lockdown, voters seem to support more national incumbents than local incumbents. On the other hand, we look at the differential lockdown, which is also a local lockdown, and we find opposite effects. After the local lockdown in the red area, voters seems to support more the local incumbent compared to the national one. So these results are suggesting that voters are misattributing the policy to the incumbents, to the politicians that are implementing them. So this may motivate and may show why they are more likely to vote for the incumbent in the red area. And this finding here can be actually interpreted in the light of the retrospective voting model, in which a voter look at the policy and reward or punish the incumbent. But this is some sort of behavioral retrospective voting model, because then the voter is making a mistake and is not able, because he is misattributing the policy. So let me then conclude, as my time is running out. So in our paper, we studied the causal effect of lockdown policy on electoral outcomes. This is an important question, as this type of restriction measures have been imposed to millions of individuals in the world, and studying this effect is important under many respects. We find that lockdown affects significantly electoral outcome and voting behaviors. These results are important also because they have extensive consequences in terms of political stability in the aftermath of the crisis. It seems that this is higher, as incumbent politicians seems to be confirmed more likely. And finally, in terms of external validity, clearly the extent to which our results can be extended outside France or outside Europe clearly depends on many local factors, such as the success of the management of the crisis or the set of specific policies implemented. So this is the last slide. Thank you very much for your attention.
Thank you, Tommaso. So we can go to Claire's discussion. Perfect. We see your slide. Can start.
Okay, so thank you so much for the opportunity to discuss this fascinating paper. I found the specification and the institutional setting very interesting and also very thought-provoking as well. So let's start, as usual, by reviewing what's the main contribution and what's the sort of punchline of the paper. So the main contribution of this paper is that this is the first study on the effect of the lockdown on voting using the actual electoral data. And the research question, which is about the causal effect of the lockdown on the voting behavior, can actually is a very important and central question that can contribute to many different sort of strands of literature in the political economy. And this research is conducted in a very clean institutional setting about French municipal elections. So they chose a very sort of a very unique setting that is particularly well suited for this kind of question. So the details of the setting are that the first round of the two-round election took place right before the election, and the second round took place after the lockdown due to the delays. And there was a very clear sort of division of the red and green zones with surprisingly similar trajectory of the health outcomes. And the empirical strategy that they are employing is the RDD, and they are also doing a large set of robustness checks in terms of the specification and also the smoothness of the covariates around the border, etc. So the main outcome variables that they are looking at is the support for the incumbent, which turns out to be quite significant, and also increase in the voter turnout as well. So the authors propose a large set of potential mechanisms, and they convincingly roll out several of the mechanisms, but we are actually going to get into the sort of more detailed discussion of these mechanisms. So overall, I think this study produces very interesting sort of empirical patterns that deserve a lot of sort of very more in-depth discussions. But before actually going to the interpretation of the estimates, we actually need to have more discussions about how convincing, how strong these results are. So let's first check the basic first step of the NERDD design, which is about the smoothness of the covariates around the lockdown border. So the authors do a very large set of checks on the smoothness of the effect of the covariates around the lockdown border. So most of them are quite convincing, but some of them are somewhat concerning in the sense that the median income has a sort of borderline significant differences around the border. And also there's an interesting sort of discontinuity at the border regarding the age of the previous mayor. So it makes us wonder whether these two set of municipalities around the border have been having somewhat different political history in terms of what kind of leaders that they have been selecting. And if you also look at other sort of appendix tables and figures, there are also other variables that kind of make us wonder what kind of other discontinuities there might be, such as the presence of runoff that is documented in figure A5. So the presence of runoff shows a bit of discontinuity at the border. So I think it would be helpful if you could actually sort of focus more on this set of covariates that have some concerning discontinuity at the border, and talk about how these discontinuities may or may not affect our interpretation of the main results on the incumbent vote share and the turnout as well. And now let's get into the robustness of the estimates. So this is the issue that actually has been raised by many people who have previously read this paper. So ideally, to make the estimate really convincing, we should want to see a very similar level of the estimates across different specifications and also different kind of variables. So first, let's look at the comparison of the estimates across different specifications of RDD. So apparently we are looking at the non-parametric and RDD-OA and CEM specifications. So the authors are primarily focusing on the non-parametric estimation. And as you can see, the estimate that we get out of the non-parametric specification is actually quite different from the estimates that we get out of the RDD-OA or CEM, where we actually put in a lot more observations. So this begs the question of to what extent this is really due to the intrinsic issue of the bandwidth, and to what extent this non-parametric estimation is really reliable, given that we don't actually have lots and lots of observations we would typically want in the case that we want to have a strong confidence in the non-parametric estimation. So the significant variation in the estimate across different specifications of the RDD is somewhat concerning. And another dimension of the estimate that is somewhat concerning is the marked difference between the estimate using the second round incumbent support and the estimate using the difference between the first round and the second round. So this marked difference between the second round incumbent support and the first and the estimate coming out, the difference between the first and the second round, makes us wonder whether there was any sort of discontinuity around the border in terms of the first round result, first round vote share, and it turns out not to be the case. So if you actually look at the details in terms of figure, we can see that there was almost no discontinuity in the first round result in figure E, the panel E of this figure. But if you actually look at the first round, the first difference, there's a mild difference. There's a mild gap at the border, and if you actually look at the second round absolute level, there's a really marked gap around the border. So this lack of level difference in the first round is kind of reassuring, but at the same time, seeing this marked difference between the estimate coming out of these two different outcome results is quite. It makes us sort of concerned about how much of confidence we are supposed to have in this estimate coming out the non-parametric RDD estimation. And the same kind of concern actually applies to the turnout result as well. So if you look at the first round turnout result, we have sort of very small gap around the border. And if you look at the second round voter turnout, there is also a very small gap. But if we actually try to look at the first difference between the first round and the second round, we actually get to see a pretty significant gap. And we can also see that there are not that many observations from the point of view of the people who actually want to use a non-parametric estimation, because non-parametric estimation typically relies on a very large number of observations. So it's a little concerning. So let's try to look at it in a sort of somewhat different perspective. So the following figure shows how the estimate varies as we actually vary the bandwidth, because the most straightforward reaction to this sort of somewhat concerning figure that we have seen in the previous slide would be to say that, you know, the RDD estimate naturally very often gives very different may give a very different estimate depending on the bandwidth that we use. So the estimate indeed changes a lot for the same outcome variable depending on the size of the bandwidth that we use. So one interpretation would be that this is just a result of this is just a sort of consequence of the nature of the estimation technique. But another possibility is that the treatment effect could actually be very heterogeneous across different areas of the municipalities. And it is very often said the most effective way that humans perceive the situation, humans learn about a phenomenon, is by the contrast. So the very fact the voters are around the border and they are seeing two very different situations by the contrast of themselves and their neighbors could actually make the treatment effect particularly strong. So I think we need more discussions about whether sort of the situation of market variation in the estimate across different sides of the bandwidth is actually due to the heterogeneity in the treatment effects, or it's more of a sort of econometric consequence of the situation.
Claire,
in the presence of
now, Claire.
Yeah. So overall, I think this is a fascinating paper, and there's a lot of there are many different aspects of the estimates that are quite thought-provoking. And another thing that we could actually delve into more is whether this is actually the mechanism is driven primarily due to the sort of emotional aspect, such as fear or gratitude, or more sort of rational aspect. That is driven by the risk aversion, and we may consider doing some sort of content analysis regarding media coverage to uncover which aspects of the voters' decision may actually have driven this kind of result. So overall, I think we have a lot of interesting aspects of the paper to discuss, and I think the paper is overall very well done, but I think there is still some room for improvement. That's it.
Thank you very much. Aymeric, your turn for the very last discussion.
So I'm the last. I'll try to be brief. So Tommaso and Gabriel brought us back to a world I was trying to forget, a world of color codes and rules on how far I can walk. And despite this effect, it was a very enjoyable read, a very nice paper, and I think also a very systematic econometric analysis. So they consider a lot of robustness, and I was pretty impressed with the econometric content. Claire mentioned some of the issues. I won't come back on them. So another thing that's very agreeable with the paper is that you can summarize them in a few graphs. So the map of these zones that follow the administrative divisions of France département, and you have this bandwidth. And this graph that Claire showed, where you see that the effect is extremely local and quite large. So on average, you have a plus 6% of the vote share for the incumbent and plus 3% on the turnout when you're in the red versus the green zone. Okay, and these graphs we saw with Claire, so I won't come back on them. But the one thing that bothers me a bit is going back to the institutional differences. So I couldn't remember really what was the difference between the green and red zone. So I went back and did a bit of research, and because it's a bit under-explained in the paper. I think you need much more description of that. And it's true, I had a hard time finding results. So there's a number of newspaper articles that were trying to explain to people what were the actual differences. And you could see the comments, and one of them, I don't usually like the comments below newspaper articles. You see a lot of depressing stuff, but this one was pretty funny. He said, for colorblind people, there's no difference at all between red and green. For the others, not much more. And that's a bit the feeling I got when I looked in the details, but maybe I'm wrong. Maybe it evolved later on. But the differences I found were the education, so the college, first grade of secondary schooling, so from 11 to 14 essentially, were open in green areas and closed in red. The parks were open in the green and closed in the red, but you could access the red. From the red, you could actually go to the green. It wasn't, the borders weren't blocked. And at the beginning, at least, the rules on how much you could move were the same, and the opening of the restaurants were the same. So maybe it evolved later on. But initially, the difference were quite weak. So maybe I'm wrong for how it evolved later on. I couldn't find information, but at the very least, you need to document it much more. But let's take the position that this is essentially a symbolic difference. And one of the things that were mentioned is that it allowed the government to potentially go back in these zones on what they had decided before. It was easier to do it in a red zone than in a green zone, to come back to a stricter lockdown later on if the situation didn't evolve nicely. So I would put the question as the result of the paper is asking is, why did an essentially symbolic measure have such an impact? And so one reason is just econometrically it doesn't hold, but that I'm convinced by the analysis, it's very serious, very, very clean. So I'm completely convinced by the effect. And so it raises the question of why do we have this effect of a symbolic measure? And they show this further evidence that Tommaso mentioned briefly on Google Trend data, for the searches for the keywords mayor and president. So I've always a hard time thinking about Google trend data, because I don't imagine people typing on their Google bar the word mayor. Why would they do that? But in this particular case, so what you show is that there's a spike in May for the search of mayor in the red zone and not in the green. And it's quite strong, and not for the word president. And it turns out that the date of the second round was actually announced a bit during that period as well. So it was announced in May 22nd. Which explains a bit the spike in May. And it was quite a contentious issue of strategic timing. There was a lot of debate of when you should run the second round, etc. And it was conditional on scientific conditions not becoming worse. So in a sense, we need an interpretation for what I would call a symbolic measure with a very local effect, and that interacts with the announcement of the date of a second round. So what mechanism could explain this combination? And so where I really agree with you is that I would interpret it as a behavioral reaction. It's your favored interpretation, that it's a behavioral reaction to this measure. And you talk about these two possibilities. One is fear. You're more scared in a red zone, so you're looking for stability and you turn to the incumbent. And attribution mistake, you reward the mayors in red zone for fighting the pandemic. So there I don't really buy these results, but again, it's not based on data, it's based on impressions at this stage, because the fear should apply all over, not only in the very local sense, so it should apply much more broadly, and it doesn't seem to be the case. And the attribution mistake, you always seem to start from the presumption that people are actually rewarding for the lockdowns, whereas I think it was a time where people were quite annoyed with lockdowns and were more potentially annoyed by these rules. So let me suggest another interpretation, which I think could have some testable implications, and I'll close on that. That the rules were partly resented by the local population. It appears a bit arbitrary to be in red versus green, especially when you're locally at the limit. And there's resentment towards the central government, in particular in rural places where you feel the rules are designed by and for big cities. It comes at the same time as an announcement of the second round where you suspect it's being set strategically. So overall, it creates a resentment for the central government that turns your sympathy towards the local government. So I think, what could you look at empirically? I think one of the things that you should look at is variation across rural versus more urban places, even in the green versus red. So was the effect differential among these two? And maybe if you want to go more in these Google trends, look for searches about, I don't know, the keywords about rules or stupid rules or whatever you want to search for that would look at annoyment of people towards the rules. In any case, my interpretation is not is based also on presumptions. It would be interesting to give more data, but you already have a very rich paper, so I wouldn't push you at this stage to go further. But I think it opens interesting questions, maybe for the next economic policy panel, which is the interaction between national and local politics. Is it true that when popularity of central government decreases, there's a balance effect, that the local governments become, you go back to your incumbents? Do voters correctly attribute policies to the different levels of government? It's a question you indirectly raise, and I think it's a super interesting one. And also for me is the question of symbolic measures of policies that do have behavioral effect, and it's a key question that still has some elements in the literature, but is still, to my knowledge, a bit understudied. So in any case, thanks for the great paper, and I'll close on that.
Okay, thank you, Aymeric. Yeah, I see many questions showing up. So, Ron, you have a question?
Yeah. So I was wondering what information did people have in the first round of the elections? Maybe that was explained in the presentation, but did people already know that there would be a differential lockdown and that could have affected the the outcome in the first round, and thereby maybe potentially also affect the outcome in the second round.
Thanks, Marco.
Thank you. Just a question about how homogeneous or heterogeneous is that area of France in terms of political preferences? So how should we read like this incumbent? Is like mono flag, or like tend to be more right or left wing, or is it very heterogeneous? So around the border, you have you observe many different mayors. You may have said this during the presentation. Feel free to skip the question if you did. Thank you.
Okay, I also a related question. I mean, about this interpretation of what you do. To some extent, to say in a provocative way, perhaps. I wonder whether your paper is about lockdown policies or good policies versus bad policies, and because so there is some heterogeneity here. So do we have any way to try to answer this question? Okay, if there is no more question, we can. Oh, there is one more, Lorenzo.
Yeah, I just wanted to ask whether you find any effect in excess mortality after, you know, the introduction of the differential lockdown, because if not, it means there was basically no need to have these stricter rules. Thanks.
Okay, I think that you have some material to answer now. So please, the floor is yours.
Okay, so thank you very much to the discussant for the very insightful comments, and also thank you very much for all the questions. So yeah, let me start discussing this. So I would like to start with the points raised by Claire on the estimates. So first of all, yeah, there is some difference between the analysis on the second round and on the first diff. So first of all, this clearly depends on the bandwidth, because the bandwidth is very different in the two cases. In the second round, the bandwidth is like 1/3 than in the other case. So clearly this affects the magnitude of the effect. If you use the same bandwidth, the coefficients gets closer in terms of magnitude. Then, and clearly this also depends on the fact that one is in level and the other is in diff, because if you compare the magnitude of the effect in the second round with the average of the dependent variable in the second round only, the effect is 23 and the average is 43. In the other case, the effect is 6 and the average is 7. So it is somehow natural to have such a large difference in the magnitude of the effect if you compare it with the average value of the dependent variable. But yeah, then there is also the argument of the bandwidth. Then the first round results, yeah, I mean, looking at the RD plot, sometimes there is some mild jump in the lines, but these results are not statistically significant. So according to the standard significance level, we are not too worried about that. Although there may be some differences that luckily is not statistically significant. In terms of discontinuity or in terms of continuity assumptions, that's true. I mean, some variables are indeed non-continuous. I mean, we check for many covariates, and for instance, age of mayors seems to be different around the border. I mean, there are other characteristics of mayors that are important as well, such as education, that seems not to be that are continuous, but we definitely need to dig more on that in order to understand why is that, and what was the potential effect of this in our general setting. Then the gratitude versus, yeah, the suggestion of conducting a content analysis on the media in order to understand better the main behavioral mechanisms, clearly a great point. We can definitely dig more on that to try to characterize better. So far, we are using text analysis only to test the channel of media visibility of mayors, but that's clearly just one thing that we could do of the many possible additional analysis we can run on that. So thank you very much. That's really really great comment. Then yeah, then going to the second discussion. So thank you for underlying this. The differences among the two areas. So we can add more detail on that. We can do a much deeper institutional check there. So thank you very much for that. The date of the second round. So you were saying something about the mechanism that about the fear, the mechanism, the behavioral mechanism, and the fear that this is likely to be present in both sides of the border. Well, this is probably the case, but the feeling of safety, which is linked to this potential behavioral mechanism, this is what may change. Probably in the red area, the feeling of safety may be much higher. So the fear is probably the same. So everyone is scared, but probably in the red area, the voters feel a bit more safe, and that's probably the behavioral component that is pushing them to reward or to vote more for the incumbent in this sense. But yeah, clearly in terms of being scared of the virus, I mean, we could also argue that if you are in the red area and you are subject to a more strict policy, you may be even more scared. But this is clearly, something we could discuss. It's really, really difficult to know what's true in this case. And about the suggestion of the variation in rural versus the urban area, that's really interesting. So we could definitely try to address this. We have the data to do that. So clearly we have some variation in terms of level of urbanization of the different municipalities that we have. We could even exploit the variation at the police station level, since we are looking at police stations. We could even exploit the variation within municipalities. There may be police stations that are more rural than others. So we could definitely do more on that. Okay, then the other point is, so the knowledge of the lockdown dates during the first round elections. So that's actually pretty clean in this setting, because the announcement of the lockdown has been done just after the first round, the announcement of the general lockdown. So it's not that voters didn't know about the differential lockdown. They didn't know neither about the general lockdown during the first round. So that's clearly quite clean setting for us. So during the first round, they were completely unaware that the government was about closing everything. So for sure, those in the red area or in the green area could not anticipate that they would have had in the future more or less strict restrictions. So that's clearly something that is quite clean in this setting. And this was for sure this was strategic from the government side. Then in terms of political preferences, yeah, thank you very much for the comments. So we show that first round outcomes are similar, but we didn't look exactly at political preferences during the first round. So what we did is we use the vote share to different parties, a vote share to left-wing or to right-wing parties, and we look whether there is some effect on this, and we didn't find anything, but this is clearly looking at the second round. So we don't know the kind of ex-ante distribution, but this is something we can definitely look at and detail more in the paper. Yeah, for sure, my co-author is more expert than me on that, but I mean, my impression is that these areas are not, we are not taking and dividing areas that are completely different in terms of political preferences. We're not comparing, I don't know, like the periphery of Paris with some very rural area in another department. But of course, this is something we definitely need to look at more carefully. And then, yeah, so the excess mortality after the differential lockdown, that's another important point. So we don't see differences before the first round between the first and the second round. Of course, we didn't look systematically at the excess mortality after the second round, which is where probably the policy may start having some good effects. I mean, we did that with an event study, and I mean, the coefficient is negative. I mean, it becomes more negative after the second round, despite not being significant. So this seems to suggest that indeed the red area, the hard lockdown, was indeed good in the red area, because of course we didn't test for that, but this may be something that we could look at. But at least this from a descriptive point of view, it seems that the excess mortality reduces in the red area compared to the green one after the second round. So it seems that the policy is giving some fruit in terms of reducing the diffusion of the virus, but we could do a diff in diff in order to check for that. And yeah, I mean, in terms of lockdown policy, yeah, I mean, the question asked about distinguishes whether, yeah, exactly, the lockdown, whether it is due to the lockdown or to basically discussing between good and bad policy. This is clearly, I mean, a big challenge we have to face in our, I mean, in this study, and we have to speculate more on that. And related to that, going back to the panelists, yeah, the mechanism of the contrast between green and red area, this is something that is maybe plausible here, that those in the green area are looking at those in the red, and this kind of interaction may be in place here. I mean, this is plausible, and this may be among the other emotional or behavioral mechanisms somehow. Yeah. So yeah, I don't know whether my co-author, which, I mean, being French has more knowledge of the background, want to add something?
No, maybe there's two small things that I'd be happy to say. So first thing is about the institutional background. So the moment when they announced this relaxation. So it was, so we didn't go too much into, we tried to give as much information as possible, but there was this kind of funny scenario where when they announced it for 2 or 3, for like 1 or 2 weeks, they showed different maps, which would tell you, which would say how it would go from the moment when the relaxation would happen. And then each map implied different kind of relaxation measures, which were the ones that were listed, but also the requirements to use this attestation to go around, and the capacity to move around more than a few kilometers around one's home. These were also relaxed, but they all came up at the same time. So but we can for sure dig deeper in that. That's the first thing. And the second thing about the question of the lockdown and of the variation of the COVID, the spread of the virus around around the border in the long run. I mean, the issue. So the point where we're trying to make here is that really at the local level, so close to the border, there was no difference, and in a sense, you might even have no effect on the spread of the virus just at that local level, but that doesn't mean that lockdowns are not efficient tools, right? It's just that they put the borders somehow where it was practical to put it to this, this is regional borders and regional health units. So they put it there, but locally you had very low difference, small differences, or no difference at all, no significant difference in the spread of the virus. So basically, it could be that the lockdown had no significant effect at the border, but that doesn't mean anything bad for not much for the lockdown policy in itself. Yeah.
Okay, thank you very much to all of you. We are just on time. So thank you. Special thanks to Mariolina, who was very helpful in organizing everything. And also special thanks to Tommaso Monacelli for all these years you spent with us, and for being so active during all these years. We are going to keep you on board for sometimes if you want to come back to some panel.
Thank you, Pierre.
So bye-bye, and see you for the next panel.
Bye-bye.
Bye-bye. Thanks.
Bye. Thank you.
Bye. Thank you.
Thanks. Bye.
Bye. Thank you.
Thank you. Bye-bye.
Bye.
Thank you.